Live from New York City this morning. Good morning for our audience worldwide. Bloomberg surveillance starts right now. Before sunrise on the East Coast, Donald Trump declared president-elect, and we've got some big moves in financial markets worldwide. Equity futures on the S&P 500 up by more than 2%. The move in small caps absolutely stunning, up by 6.5. In the bond market, check this out. It started at 7:30 Eastern time yesterday evening. Yields higher by 17 basis points on 10s, on 30s, up by 20. And in foreign exchange, once you see a move like that, Anne-Marie, you know what's happening in foreign exchange. The dollar, a whole lot stronger.
So everyone's pricing in. Obviously, Trump won this presidential race. Whether you like him or not, this is the greatest political comeback we have seen in our lifetime. There's only one other president historically who's done this, and it's Grover Cleveland in the late 1800s. But to Lisa's point, what is likely also being priced in, we know the GOP now has control of the Senate. We're still waiting to see how big that majority is going to be, but they already have control. Now we're just waiting on the House. Whether or not the House remains Republican, Donald Trump will be going in as the 47th president, basically, potentially, with a mandate. So all those election campaigns and slogans and promises, some of them may actually come to fruition, and that is what you're seeing playing out in the financial markets.
It's clear a lot of people were up all night. It's clear that a lot of people were at their trading desks, and whether it's speaker issues, whether it's trading desk issues, we've gotten a bunch of notes out of a number of different Wall Street desks. One of them, George Saravelis of Deutsche Bank, now saying he expects euro-dollar of 105. Stuart Kaiser of Citi, and this I think is really interesting, saying there are two key risks to this euphoria that we're seeing in equity markets. The first one is a further surge in bond term premium. At what point does the sell-off that we're seeing in bonds, John, end up curtailing some of the euphoria that we're seeing everywhere else?
So Chris Verona Strategist wrote in a little bit earlier this morning and said to me, I'm a buyer of bonds this morning. You can quote me on that one. So I just did. He's a buyer of bonds this morning.
We heard a similar note from Peter Scheer of Academy Securities, who I know is on with you guys about an hour ago. And really what he basically said, not sure treasuries are screaming buy, but I don't think Trump will be as bad for deficits, at least not initially, as is getting priced in. Now comes the game of who is coming in, what the personnel are going to be, and what the composition is of House, where we now have still, I believe, 19 toss-up races that have yet to be called.
So if you are just tuning in, welcome to the program. We begin with our top story. Donald Trump heading back to the White House.
I want to thank the American people for the extraordinary honor of being elected your 47th president and your 45th president. This was a movement like nobody's ever seen before. And frankly, this was, I believe, the greatest political movement of all time. I will not rest until we have delivered the strong, safe, and prosperous America that our children deserve and that you deserve. This is a magnificent victory for the American people that will allow us to make America great again. It's time to put the divisions of the past 4 years behind us. It's time to unite.
Donald Trump securing the necessary 270 Electoral College votes to return to the White House. Vice President Kamala Harris staying silent overnight, expected to speak later on today. Our team coverage starts right now with Bloomberg's Tyler Kendall in West Palm Beach and Akayla Gardner in Washington. Tyler, you've been up all night. I imagine some of the Trump campaign have been up all night as well. Walk us through the mood.
Yeah, good morning, John. I was there at the Palm Beach Convention Center where now President-elect Donald Trump made those remarks that you just played, saying things, as you heard, that he is leading the, quote, greatest political movement of all time, and also in a bid to try to bring some unity, urging Americans to get past their disagreements. But I also want to pull on something that his vice presidential candidate, now-elect J.D. Vance, said, because he ended his comments on the economy. I know that we've been repeatedly talking about it this week leading up to Election Day, since it was the #1 issue for voters. But if I could just pull on some of the exit polling that we trust, that shows that 48% of those surveyed yesterday on Election Day say that they were concerned about the prices of gas. 51% saying they are concerned about the prices of housing. When we then pair that with our Bloomberg News Morning Consult poll, which has repeatedly shown now President-elect Donald Trump leading Vice President Kamala Harris when it comes to voter confidence on handling the economy, that can give us some insight into what propelled him in some of these critical battleground states like Wisconsin, which just landed in the last hour or so. Now, you alluded to it at the top. Another critical thing for now President-elect Donald Trump last night was that Republicans flipped the Senate. No matter what type of agenda, economic or otherwise, a president in a new administration needs to work with Congress to get his legislation through. John, we should note that the House is still too close to call. However, we do know that House Speaker Mike Johnson flew from Louisiana, was there on stage with him last night here in Palm Beach, and he's spending the day here working with the Trump team.
Kayla, it was a bruising defeat for the Democratic Party last night and potentially can get even worse when we get more of these states being called in terms of the down ballot races. What are we expecting to hear today from the vice president?
Yeah, well, the Harris campaign has been pretty quiet yesterday and this morning. We know that Vice President Harris is going to speak today, but this is a hard pill to swallow for the Democratic Party. They have not only lost the White House, but the Senate. That was sort of expected here. We thought that the Senate was going to go Republican, but the Harris campaign said that this race was going to be close when it comes to the presidential. That has not been the case. They had also said it could potentially take days. Of course, we're now knowing less than 24 hours after polls close that Donald Trump has won the presidency. And perhaps the hardest pill to swallow is the fact that this party pressured Joe Biden to step out of this race less than 4 months ago, hoping that another candidate could really carry the baton. Vice President Harris was not able to do that. She was not able to overcome Donald Trump's advantage on the economy and immigration. And now she's going to have to face that. And voters across the country, especially women voters, are going to have to face the fact that we are still not going to have a woman president. Really, people hoping that she was going to be able to break that barrier, but not the case today.
You both need to get some rest. On behalf of us all, thanks for the hard work overnight. Kayla Gardner alongside Tyler Kendall. Isaac Boltanski of BTIG joins us now. Isaac, welcome to the programme. We've got some time to work through some of what we've learned overnight. What went right for Trump and what went wrong for Harris?
I think it's going to take a lot of time for us, and I think that there are going to be a number of postmortems on this. In talking to Democrats, I've already heard a fair amount of focus on the economy. Obviously, that's the number one issue. That's what they're starting to see from the exit polls. But there are also claims and concerns of misogyny and other issues that are in play. And so I think Democrats are going to have a lot of soul searching to do, John. This was a resounding shellacking that they received last night. I mean, when you go through some of these numbers, it's pretty staggering. Trump expanded on his previous margin in 2,300 counties. He only decreased his margin in 240 counties. That's absolutely astounding. Just the fact that he won the popular vote is something that I don't think many of us had anywhere near our bingo card. So I think for Democrats, they're in the wilderness right now. And I think it's going to be a long few years before they figure out who their new standard bearer is and what their message is.
Well, when it comes to the standard bearer of the Democratic Party, the sitting incumbent president, do you think the fingers are really going to be pointed at him right now, or is it the VP?
I think that we're going to have a circular firing squad in the Democratic Party for the next few days. I think that everybody is going to have to eat a little bit of blame for the strategy here, and realizing also that there was a tough hill to climb here, right? And I think that we're going to have a lot of revisionist history in terms of when we should have had Biden exit, if we should have had a full primary. All of those things are going to take up a fair amount of time and air within the Democratic community. The question to me is, are they going to be able to govern from the House, or are they going to be in a minority there as well? That's the biggest question for me, and I think everyone else at this moment.
What are the tea leaves telling you about those House races right now? There's some dozen or 24 we're still waiting to hear from.
Look, all of my Republican contacts are optimistic, but that might be just the broader euphoria that they're feeling this morning. It's going to take 2 or 3 days. We're going to have to buckle in for this. Ultimately, I think what I've tried to highlight to clients over the past few months is no matter who's in control of the House, it's going to be a very slim margin from the looks of it. And you're going to have the same dysfunction that we saw with the speaker fight just last year. And I think that's going to be a theme that markets are going to have to deal with, especially as we get to some of these big ticket spending efforts that I think we all care about.
Isaac, just to build on that, I think is one of the big questions in markets this morning. We were just speaking with Marvin Lowe, for example, who was saying he thinks right now the bond market and broader markets in general are pricing in just Donald Trump at the top of the ticket and the Senate turning red, not a red sweep. What are you hearing from clients about how much you could get a very much accelerated move on the idea that those 19 still undecided votes that could flip the House do go the way of the Republicans?
Yeah, look, it's a huge procedural issue, right? If you have Republicans in charge of the House, you're able to use budget reconciliation, which is an incredibly powerful tool, as we all know. And I think we would have to change some of our assumptions at that point regarding what will be spent over the next 2 years. And so to me, if you have that red sweep and that's confirmed over the next few days, then I think our deficit assumptions are going to have to be ticked up a bit because of the budget reconciliation process. And so to me, that's the ball game at this point when we think about it. A lot of what we're going to do over the next few days is separating rhetoric from reality, right? How much of his immigration proposals is he going to advance? How much of his tariff proposals is he going to actually advance? But on the spending side, the most important issue here is, do Republicans have control of the House? Because that unlocks budget reconciliation, and that's an incredibly powerful means of advancing your agenda.
There's been a lot of discussion around who Donald Trump would surround himself in the White House, who his cabinet would be, what kind of tenor it would be, whether it would be hawkish, whether it would be dovish when it comes to foreign policy, when it would be more expansionary or hardline or not. Do we have any early indications based on who was with Donald Trump last night, who he is surrounding himself with early this morning?
I found it interesting that we saw the return of his daughter and his son-in-law to the stage. I think that's not something that we've seen recently on the political side. So I think that's noteworthy and is something that we should continue to track. I think you're also going to see the return of other folks who have maintained their place in the orbit, whether that's Steven Mnuchin, or you're going to hear a lot more from Robert Lighthizer, who I think we're going to have to keep our eyes on for Treasury Secretary. Those are some of the names. I think that there also is going to be a pronounced focus on Wall Street. Look, John Paulson is part of this conversation. For example, you've seen a number of other hedge fund managers who I think are going to have the ear of the president. I don't have the answers at this point, but I know that those are some of the names that you're hearing mentioned most frequently.
Isaac, appreciate your time, sir. As always, no doubt we'll be talking again soon. Isaac Boltanski there of BTIG. Isaac mentioned the financials. Check out the banks in the pre-market. If you have a moment in your morning so far, I know everyone's super tired, but if you just have a moment, just check out the banks in the pre-market. JP Morgan is up by 7.5%. We're talking about like the biggest financial institution on the planet, up by 7.5% in the pre-market.
Yeah, how much is this because Donald Trump did win and is going to make deregulation, in particular around banks, part of the issue? Sherrod Brown, who is head of the Financial Committee over in the Senate, kicked out and overturned in Ohio. How much are you looking at races like this to give you a sense of what's going to happen? Not just JP Morgan's of the world, PNC up more than 8%. Regions Financial, a similar type of move. This is across the board from big to small.
A bruising defeat for Sherrod Brown. I think it was very telling at that moment in the night when that headline dropped. You realized people were not voting with a split ticket in mind. They were voting red across the board in a lot of these states that, it was going to be tough for Sherrod Brown, Senator Brown, to really pull that off. But there was a lot of money spent on this race, the most expensive Senate race in history. It was very telling that really was going to be, this was the red wave they never got in 2022.
These stocks are getting more expensive. Bank of America up by 9%. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu fired his defense minister, Yoav Gallant, yesterday. It sparked widespread protests by citizens and opposition politicians. Gallant had pushed for a hostage release in exchange for a ceasefire with Hamas. The prime minister, on the other hand, wanted to press on with the war. Netanyahu and Gallant also clashed over domestic political issues, in particular the conscription of ultra-Orthodox Israelis. Musk has more lawsuits coming. The Tesla CEO and his pro-Trump America PAC were sued by two swing state voters in separate lawsuits. One alleges that Musk and his PAC profited from the contest by driving traffic to his platform X, which could collect personal data that in turn could be sold. The second suit claims that the giveaway was partisan and eliminates anyone who isn't a Republican or a Trump supporter. NVIDIA has become the largest company on the world, sealing the day that on Tuesday, surpassing Apple, underscoring just how dominant AI has become on Wall Street. Shares rose 2.9% during the trading day yesterday. They're up again pre-market 1.5%. Market cap hit $3.43 trillion. The chipmaker accounts for 7% of the weight of the S&P 500 and is responsible for about a quarter of the benchmark's 21% gain so far this year. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Trump's pledge for his second term.
I will govern by a simple motto: promises made, promises kept. We're going to keep our promises. We will make America safe, strong, prosperous, powerful, and free again.
The view on the markets just around the corner. Equity futures on the S&P 500 up by 2.3%. The small caps absolutely flying. From New York City this morning, good morning. Equity futures flying here on the S&P 500 higher by more than 2%. The move on small caps. The move on small caps is nuts. We're up by 6.5% on a Russell. Under surveillance this morning, Trump's pledge for his second term.
I will govern by a simple motto: promises made, promises kept. We're going to keep our promises. Nothing will stop me from keeping my word to you, the people. We will make America safe, strong, prosperous, powerful, and free again. And I'm asking every citizen all across our land to join me in this noble and righteous endeavor.
So here's the latest. The Trump trade gripping markets worldwide, with Donald Trump winning the race for a second term as president of the United States. Anastasia Amoroso of iCapital writing, there is a sense of certainty and clarity as to what the playbook should be. Long stocks with the focus on domestic companies, long dollar, expect higher rates and steeper yield curves. Long financials, the negatives are that the tariffs can come sooner this time around. Anastasia's with us around the table. Anastasia, good morning.
Good morning.
Are there some moves on the screen at the moment that you think that maybe people should be fading?
No, I don't think so. I mean, you were mentioning how small caps are really up bigly this morning. But if you look at the performance of the Russell 2000 index, we're actually not gone anywhere in about 2 or 3 years' time. So I don't think it's a fade. And, the thing is, there are election trades that have been whipsawed around. But the truth is that we now have a new investment regime, most likely for the next 4 years, or at least the next 2 years until the next midterm election. So that means you can actually commit to some of those trades. And, the reason why small caps in particular are rallying so much is because they are typically more sensitive to, Republican majority. And so that's helping sentiment. They're also more sensitive to the domestic orientation and potential for lower taxes. And of course, they're sensitive to rate relief. And so you kind of have this perfect combination of factors that's at play now.
There can be too much of a good thing. This, according to Michael Zezas of Morgan Stanley, a concern that if it is a full red sweep, suddenly there is a fear that yields keep climbing and it curtails some of the trade that we've seen, particularly in risk assets. How much are you looking for that tipping point, or how much do you reject that and say this is going to come on stronger growth? And frankly, this is an economy that's shown again and again it can handle yields of this type.
Well, let's talk about yields. First of all, the 10-year has already risen by 80 basis points since the beginning of September. And if you look at the reaction of the 10-year in 2016, in November, December, it also rose by about 80 basis points, but then it sort of flatlined. I also think the regime right now is very different than we saw in 2017 and 2018, because remember, the Fed was raising interest rates, was in the hiking mode in 2017 and 2018. Today, they're in the easing mode. So I think that's a very different backdrop. So that's one point. The other point is, Lisa, you're right. We had to reprice for higher growth, maybe for some higher inflation expectations, and maybe for less rate cuts. But we've done that. And if you look at the fair value estimates, whether it's from Bloomberg, whether it's from analysts at JP Morgan, the 10-year Treasury right now is above that fair value estimate. And then the last thing, I know that, first of all, it's not a done deal that we have a red sweep. And, the second thing is I know people worry about what does a red sweep could potentially mean for budget deficits. But I think there are a lot of Republicans in Congress that actually do want to rein in budget deficit. So for me, it's not a done deal that a red sweep results in out of control spending.
So how much do you lean into? You said you do like regionals, you do like small caps, you do like some of the trade. Do you also lean into the dollar at the strongest level in a year? It's surged. The Bloomberg Dollar Index surged the most going back to March of 2020 overnight, just giving you a sense of how big the move is. Do you lean in, or do you say, okay, it's over, let's reassess and figure out the pieces?
No, as I mentioned, I think it is a new regime. And, I think it is going to focus on protecting the domestic economy and bringing more flows back into the United States. And all things equal, that should be dollar positive. I also think that maybe the Fed does move a little bit slower than they could have otherwise if you do have, this boost to growth. So all of that is supportive for the dollar. Personally, of course, I do look more to the equity markets, and I think of what does this mean for the places I want to be in the equity markets. And that's why you go to small caps. That's why you go to regionals. That's why you actually probably put together a basket of stocks that has a high percentage of domestic revenue. By the way, we've done all that. We've done all of that in 2017 and 2018. So I think we may need to dust off some of those trades.
It could be days, maybe even a week or two before we actually figure out the full composition of Congress, because what is going on with these House races? This might come down to California, absentee ballots. It could take a long time. So then I want to talk about tariffs, because unilaterally, Trump can come in and do this on day one. And you say this could be sooner than 2016. You just got back from Asia.
Yeah.
How is a place like China preparing for maybe 60%?
Well, it's very interesting, and they are preparing for it, but what they're truly preparing for is a negotiation. And the sentiment that I personally picked up from some of the conversations is that China policymakers are not actually afraid of Trump 2.0. They might actually be welcoming Trump 2.0. And the reason for that is their mentality is transactional. They also want to get a deal done. They also want to negotiate certain things. And so the ability to engage in negotiation, that's what they're focused on.
So would your advice to investors be, this was Donald Trump on the campaign trail having negotiating tactics, or do you think he comes in and puts blanket walls up as high as 40, 60, 70%?
Well, I think he might. I do think there has to be some consideration given to what does that do for the consumer that voted for him, the consumer that voted lower inflation. You probably want to be careful as to how you phase in and scale up those tariffs. But at the same time, in the Bloomberg interview, I guess a month ago at this point, he did talk about this being a negotiation tactic. He talked about, you can't put a 10% tariff and expect to bring people to the table. When you put a 60% tariff, that's when people come to the table and want to negotiate. But once again, I think the ultimate end game is not to have 60% tariffs in place, but is actually to convince China, for example, to build factories in the United States. So that's hopefully what the markets are going to be focused on as well.
We've got a lot to work through. Anastasia, it's good to see you. Bond yields are higher by 20 basis points on a 10-year, but the dollar's stronger. Is it fair to say this morning that we're baking in a better profile for growth, maybe higher inflation, the prospect the Fed can't cut too much, and not real deficit concerns that lead to a buyer strike? Because if it was the latter, you'd expect some dollar weakness, and we don't see that.
This is an embrace of American exceptionalism. It is not a rejection of it. And I think that you see that in the dollar, even though you have these higher yields. What people are looking at right now is the idea that you're going to get deregulation, that the tariffs will come, but there'll be more negotiating tactics, that maybe there'll be some sort of regulating force, and that the deficit won't become as problematic as we currently see. Watch that 30-year auction. See what that clearing moment is, as Priya Misra likes to talk about, and then we can go from there.
The 30-year today's up 23 basis points. It's quite a day to have a 30-year auction.
There's also a lot of questions about the sequencing and exactly what type of inflationary push, whether it is growthy, to use some of the language, or if it's actually going to come with some disinflation because it suppresses growth.
Big moves in markets worldwide. Coming up on the program, we're live from the key swing states of Pennsylvania and Michigan. What went right for Trump? What went wrong for Harris? Live from New York City, this is Bloomberg. Many of you waking up to this, and this move really started at 7:30 Eastern Time yesterday evening. We weren't getting surprises from state to state, but we started to see some things in counties starting to shift Trump's way. And this market started rallying really hard and never looked back. The small caps up by more than 6%. On the S&P 500 up by more than 2%. In the bond market, yields up by double digits, up by more than 20. On a 30-year, up by 19. On 10s at 445.91. On 2s, up 9 basis points to 427. This Federal Reserve meeting this week, snooze. December gets a whole lot more interesting. Looking out to 2025, if we get this sweep confirmed and we start to look out to 25 and beyond, all the policies, and this market's starting to price in a much growthier inflationary outlook, can the Federal Reserve keep reducing interest rates?
That was exactly the question that TD Securities and the team over there was asking early this morning. This is their conclusion, that it is likely that the Fed will remain on hold during the first half of 2025 after cutting rates maybe 50 more basis points because of exactly that. This raises a question of a higher benchmark rate going forward. We have to see what the policies are, how they trickle out, a real question about how much growth versus inflation we're going to see. But the bottom line is this. This is the worst case scenario for a lot of bonds. At the same time, it hasn't mattered for stocks. So is it really? And I think that that's really one of the main questions.
It's the best case scenario for the US dollar right now across the whole of G10 and against EM as well. Danny did a phenomenal job of this yesterday evening. The difference between a tariff trade and a rates trade. And I can pick up two currency pairs for you right now and walk through it. The euro, a rates trade. We're down 2%. Euro dollar just about holding on to 107. The peso, a tariff trade. Dollar MEX up 3% on that currency pair. Big move.
Yeah, and it's the biggest going back to 2022. The dollar, the strongest versus the peso going back to 2022. A key question here about whether they'll be the target of a lot of these tariffs because of their role as a conduit of Chinese goods. Here's the question. How much of this is a sequencing matter? How quickly this gets into effect, because these are some of the issues that can be done unilaterally. With the euro region, that's a real question at a time where you have a real differential and now it's just growing. And you have to imagine the ECB is going to be loath to cut rates too aggressively because they don't want to widen that differential too much.
Worst fear for Berlin and Brussels, without a doubt. And I imagine you hear some people say things today like they're prepared for it this time in a way that they weren't last time. And people might say the same thing about NATO as well, Anne-Marie, and we can talk about that right now. I would say this, though. That Eurozone economy is not in a good place. The German economic model is not in a good place. There is a war on the doorstep of Eastern Europe right now as well. I don't think we can sit here and say they're better prepared for it this time around because I think the European economy right now is weaker this time around.
And it's going to get worse because if the walls go up, it doesn't mean the walls are just going up for imports coming from Europe into the United States. The walls are going up for Chinese imports. China, where do they have left to go? Where are they going to dump? On Europe. It becomes much harder for Europe. I got some messages yesterday for individuals who were hanging out with some European representatives in Washington, D.C. And to be honest, they were bracing for impact. The biggest thing they were most concerned about was how are we going to deal with tariffs? How are we going to deal with former president's rhetoric when it comes to NATO?
Under surveillance this morning, former President Donald Trump winning the U.S. presidency for the second time, taking key swing states Pennsylvania, Georgia, North Carolina and Wisconsin. And right now in the headlines, another projection just crossing.
That's right. Senator Jon Tester has lost his seat. Republican challenger Tim Sheehy has won. Look, Tester, three-term incumbent. Clearly, Montana has soured on him. Going into this was the feeling that everyone thought he was going to be kicked out of the Senate. But you cannot bet against Jon Tester in the sense that he has had challengers before and he's been able to come out on top. This was his toughest challenger yet. And this just says this is another R in the column for Donald Trump to go in with an even bigger mandate and basically some more maneuvers he can do in the Senate. Maybe he can pull, instead of one senator out of the Senate to maybe go to the Secretary of State or another department, maybe he can play around and have two because this is definitely a red state. Jon Tester, though, political fight of his life, and he lost it.
So here's the latest on the Senate. Republicans winning the majority in the U.S. Senate. The GOP defeating banking chairman Sherrod Brown in Ohio, fending off a challenge in Nebraska and picking up an open seat in West Virginia. The win coming ahead of key tax and spending battles for next year. I think we should talk about the Senate Banking Committee because banks are up big time this morning. JP Morgan up by something like 7, Bank of America up by more than 8.
Donald Trump ran on a deregulation campaign, and that seems to be the people he's surrounding himself with. And to boot, to your point, Sherrod Brown, who is the head of the Banking Committee, getting tossed out in this race. It raises the question of just how optimal this is, also coming with higher rates and potentially more mergers and acquisitions. That is what I'm watching. Who do they put at the head of the FTC that could potentially give more clarity onto whether deals can actually get done?
That's a great question, especially since we know how J.D. Vance felt about the one person in the Biden administration he thought was doing a pretty good job, and that was Lena Khan. Going back to Senator Sherrod Brown's race, Bernie Moreno picking that up. This was the most expensive Senate race in history, eclipsing the $412 million spent in that Georgia 2020 race between Jon Ossoff and David Perdue. A ton of money was spent to try to keep Sherrod Brown at the top in the banking committee. The issue was, for him to win this race, you had to see more split ticket voters. What did we see last night? No one was splitting their ticket. This was not a red ripple. This was potentially, let's see how the House shakes out, but this was a red alarm across the board. This was red, red, red.
That's an alarm for the Democrats. The final piece of the puzzle, which way does the House break? The Federal Reserve kicking off its two-day policy meeting today. Economists expecting the central bank to cut interest rates by 25 basis points tomorrow. Traders awaiting Chairman Powell's news conference for clues on the Fed's December meeting. In December, they have to put out new projections. Now, there's a big difference, as we all know, between campaigning and governing. And we don't know whether these campaign promises become legislative reality. But ultimately, if you have to put out some promises, some forecasts in December, at a time when we've got a better picture of what the outlook is for policy in Washington, how offside is this Federal Reserve going to look?
I've heard that dartboards are on sale on Amazon, and I believe that they're putting one up.
And blindfolds too?
And blindfolds, and they're just going to have targets and throw them at them. To me, what this does is it puts the Fed on the back seat. People aren't going to be paying as much attention to what the Fed says or does at the meeting tomorrow or potentially in December. Next year, it makes it very interesting, because then you'll start to understand, as policies take shape, does it put the Fed on hold? And right now, they're not going to mention this. They're going to stay far away from this. But that, I think, is what markets are trying to suss out.
We certainly need to get Adam Posen of the Peterson Institute back on this program, because it was months ago, when no one was talking about a mandate for Republicans, that he was saying potentially next year it's going to be inflationary. If you have tariffs, it's going to be even harder, and the Fed may have to start hiking. And you have to think, what is Jay Powell going to say tomorrow morning? How difficult is this going to be, especially since the former president recently said it's the easiest job in Washington? It's a coin toss.
I think in some ways this might be the easier one, relatively speaking, compared to, say, December, because he doesn't have to provide projections. They don't have to provide a commitment to December, and he can steer well clear away from any conversations regarding Washington, D.C. I just think it's the December meeting where this gets a whole lot harder for this Federal Reserve. The market's already trading 2025, 2026 and has been for a long, long time. And now it's trading that with some greater clarity. Federal Reserve can't play the game just yet.
That's a great point. In other words, this market is basically tightening. You're seeing financial conditions tighten on the heels of the cuts that they've already made. If it continues, they need to respond to that, if nothing else. If they want to see it easier, then they need to make some sort of statement and give some sort of sense of what their path could be.
Let's get you some team coverage from two key swing states. We can do that now with Bloomberg's David Gura in Philadelphia. Romain Bostic is in Detroit. Romain, something you said this time yesterday morning stayed with me. We were all talking about the economy and you said two words: foreign policy. In the data that you see so far, how are things stacking up? Does it speak to that?
It certainly does. We haven't gotten the full breakdown on sort of a precinct by precinct basis, but it does appear that some of those swing voters, some of those undecided voters who were concerned about some of the foreign policy stances of the Biden-Harris administration did manage to swing the vote in several key areas. I do want to talk about a differential here, and I'll throw this back at you, John, because you said something overnight during our coverage. We asked one of our guests that really stuck with me, and that was, what is Joe Biden thinking right now? Michigan is no longer a blue state. Let's make that clear right now. And it's not just that Harris lost this state, but she underperformed Biden in almost every way imaginable. Biden in the last election won 11 of the 83 counties here. Harris this time around looks like she's only going to win 9. And of those 9, 7 of those counties, she underperformed Biden versus Trump on a percentage basis when it comes to the margin of difference here. It gets even worse than that. When you look at the House races, based on the final counts that are coming in just this morning, it looks like the 13 House seats that the Michigan has in the U.S. Congress, 7 of those seats will be held by Republicans. That will be the first majority that they have held on a House basis in quite some time. And adding insult to injury, one of those seats that got flipped from Democrat to Republican was the seat that Alyssa Slotkin vacated in order to run for that vacant Senate seat. And it looks like right now, based on the vote tallies, that she will lose that race, making Mike Rogers the first Republican senator in the state of Michigan, going back to the early 2000s, 2001, and only the second Republican senator in the last 67 years.
It's shocking, and Romaine, what I can tell you is I imagine the incumbent president, Joe Biden, right now is thinking, I could have done better with rank and file voters in Detroit, in the suburbs of Detroit. Romaine, what are you hearing about the individuals who voted, who swung this election for Donald Trump?
I'll tell you, Emery, it's still very early here. The sun's not even up. I'm going to spend a lot of day asking those questions. My guess is the Harris campaign is going to spend a lot of time asking those questions as well. It's not quite clear why this swung, not just in the direction of Trump, but why it swung so forcefully. Remember, as of right now, Trump is up by more than 100,000 votes in basically a state that Biden won by 150,000 votes 4 years ago. So what went wrong? It wasn't third-party candidates that were the spoilers, but it does appear that his message did resonate with a lot of those swing voters. That includes Arab and Muslim Americans. That includes Jewish voters. That includes a lot of the Eastern European voters. It includes a lot of Hispanics and a lot of black males.
David, we just heard from Romaine there talking about the fact that it looks like the Republican open Senate seat in Michigan may go to Republican Mike Rogers. Sorry, it was a Democrat that held it as the incumbent. David, what is going on with the down ballot Senate race in Pennsylvania? Does David McCormick beat the incumbent, Casey?
Right now, he's in the lead, and I think that's something we're going to watch very closely over the course of this day. Can he hold on to that lead as the remaining votes are being tabulated and come in here? But I think that's a surprise to a lot of people who looked at the polling going into this race and saw just a few weeks ago Bob Casey, the incumbent Democrat, with a 9 percentage point lead over David McCormick. That, of course, narrowed in that latest poll from the New York Times and Siena College. But you cannot overemphasize how much Bob Casey is a son of this state, has been here in the Senate for 3 terms, was looking to his 4th, has this heritage going back to his father, who was the 2-term governor of this state. Just somebody who is a real institution in this state, and this is a huge move. In fact, it plays out the way it looks like it is. You know, I want to pick up on something that Romaine Bostic said just a moment ago, and that's underperformance. Yes, the kind of topics and issues are different here. I don't think foreign policy played as big a role here in Pennsylvania as it did in Michigan, but you look at this state and where Kamala Harris won and where she didn't. Where she did win, she underperformed Joe Biden in that last race, and this is a story of the kind of Rust Belt cities and the rural parts of this state. We had a lot of conversations last night about how big and varied and diverse this state is. I'm here in a city that historically has gone for Democrats. Indeed, we saw that in yesterday's race. Democrats still had an edge here in Philadelphia and the surrounding suburbs and exurbs, but you move west, very red, and that is an area that Donald Trump was really able to capitalize on here in 2024 in much the same way that he did in 2016. You look at kind of the data that we have thus far, and like Romaine, I'll be studying the numbers and talking to folks over the course of the day here. He appealed to those same voters who ushered him into power back in 2016 quite successfully this time around, guys.
David, just quickly here, I'm curious, it is early days, but are we getting some sort of sense from the exit polls, from what people have observed in terms of the number of voters, about the size of turnout as well as the composition across the state?
We don't have a huge amount of detail here on composition yet, but we know that turnout was huge. We know that the number of people who turned in those mail-in ballots early, that was a big number as well. Maybe not mirroring what we saw during the pandemic, but getting close to it. As Anne-Marie and you have said over the course of the morning, look, so much money was poured into this race. So much effort was made to turn out voters from both the 2 candidates and their campaigns and these outside groups. That effort really paid off. And I was thinking as I went to bed for just a few short hours last night, sort of what path forward the Harris campaign might have to challenge this. What I kept hearing from every county official I talked to yesterday was, yes, how big the turnout was, but how kind of seamlessly everything run. There weren't the kind of aberrations that we saw in cycles past. So I think that there is a recognition among the Harris campaign, certainly, that they had very little movement here in terms of what they could do to kind of challenge anything here in the Commonwealth of Pennsylvania.
David Romaine, I've said this a few times over the last few days, but truly world class over the last 48 hours. Appreciate it, guys. David Gura, Romaine Bostic. Equity futures right now on the S&P 500 up by more than 2%. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Novo Nordisk shares are surging in the European trade 6 1/3%. The company's weight loss drug saw a jump of nearly 80% sales last quarter. Revenue for Wegovy climbed 79% after the medication became available in more countries. Sales rose by 50% in the U.S., even as prices fell. Novo does have an edge over its rival, Eli Lilly, who reported disappointing obesity sales last week. A ballot measure for protecting access to abortion in Arizona has passed. Arizona had been considered among the most restrictive states for reproductive rights. It was one of the 10 states where voters had a direct say on the issue at the ballot box. The state will now amend its constitution to establish a right to abortion and prohibit interference before fetal viability. In Nebraska, a ballot measure limiting abortion access won by a slim majority, prohibiting the procedure after the first trimester. And shares of Tesla, they are surging nearly 13% in the pre-market as Donald Trump seals a return to the White House. Investors betting that the car maker run by Elon Musk will be a major beneficiary of a second Trump term. Musk was arguably the most prominent supporter of Trump during the election, backing Republicans with more than $130 million in spending. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in 30 minutes. Up next, King Dollar.
The dollar's strong because the United States has had exceptional fiscal policy. The biggest threat to Trump is going to be inflation. He'd have to change some of his policies if he wanted a weaker dollar.
That conversation up next, live from New York. This is Bloomberg. A snapshot of the price action. It looks like this. Equity futures up by 2%. Check out the euro, holding on to 107. 107.07, negative 2%. Under surveillance this morning, King Dollar.
The dollar's strong because the United States has had exceptional fiscal policy. The strength of the fiscal stance in the US compared to everything we've done in Europe is that it has helped the economy outgrow the rest of the world spectacularly. Trump wants more growth. The biggest threat to Trump is going to be inflation. He'd have to change some of his policies if he wanted a weaker dollar. You get the currency your policies give you, not the currencies you wanted.
So here's the latest. The dollar surging the most since 2022 as US President-elect Donald Trump claims victory. Mark McCormick of TD writing, a Trump win or red wave are bullish for the US dollar. We favour long dollar exposure given scope for growth and equity outperformance and as a Trump hedge. Mark joins us now for more. Mark, we've got a lot to work through, but it's the equity piece of this that I think makes your call slightly more original. What is it about the equity market that you think is going to basically feed what happens in foreign exchange?
I think one of the things that's really interesting, you talk to clients, like one of the things you try to figure out is what is the gap between productivity? It is one of the linchpins of all FX behavioral models is trying to figure out relative productivity trends. The thing that we get from equity markets is they tell us real time about innovation, about sectors, about how markets are performing. So one of the things that you can do is you could actually kind of see real time which countries are generating the most potential productivity over time. And that's where I think U.S. equities performing relative to, say, Europe and China are the thing to watch in terms of how well the dollar could perform. It's also one other reason why the dollar has continually outperformed its overvaluation on a lot of these slower, longer term models.
So let's go there, especially given the fact that there's a difference when it comes to currencies that are differentials in interest rates versus those that are a tariff trade. We were hearing about that from Danny Berger last night and through the morning. How much are you seeing this more as a trade from interest rate differentials, growth differentials, and less relevant when it comes to some of the tariff trades? And I'm thinking in particular of the yuan and more significantly, the Mexican peso.
Yeah, I think you have to unpack that it's pretty much a lot of the major things that drive FX. It's equity performance, it's growth outperformance, it's rate differentials, it's the risk premium that comes through on the trade uncertainty. So if you look at kind of your WCRS screen on Bloomberg, what you're going to see, this is a broad dollar move. So if we think about it, this is U.S. exceptionalism. So the key tenets of this is basically emerging market currencies are going to underperform, largely because with U.S. exceptionalism, you have outperformance of U.S. equities, you have a steeper curve. The number one thing the market's going to talk about now is the higher terminal rate in the U.S. where that lands, how the markets have to reprice the Fed, whether the Fed is going to be on pause now starting in December. All those things are going to be very bearish for pretty much every emerging market currency. Asia's more focused a little bit maybe on rate differentials. But if you go, again, back to Latin America, if you think about the Mexican peso, this is the worst case scenario. You have trade uncertainty. You have a USMCA sunset clause that comes through in 2026. You have an underperformance of the carry trade. And now you actually have the uncertainty of whether or not Trump wants to strike a deal with China and find a way to cut Mexico out of the supply chain, or if he wants to find a way to basically say to Mexico, we're going to renegotiate the trade standards here that we have in USMCA, which puts them down a rung anyway. So those are all key concerns. I'd say with the euro, again, we have uncertainty around the German government, which is likely to collapse at some point in the near term. And we're looking at potential elections in Germany. So there's political uncertainty in Europe, and there's pretty much, growth revival that's coming through in the U.S.
Right now, it's not really volatility. It's just straight and up to the right. I'm just wondering how much we end up with, if there is a wobble in equity markets, that will be that much more damaging to the dollar because it does undermine what you're talking about. How much do you take notice if there is a sell-off?
Well, I do think that you have to work through the first and second order effects. So as a lot of people have mentioned, we've underscored as well, all these policies, especially if there's a red wave, if they have the House as well, this is going to be inflationary. The first order effect is this is kind of very bullish again for the equity market. This is a repricing of the Fed. This is a steeper curve. This is a bit of a reflation trade with the theme around U.S. exceptionalism. The second order effect is, again, and we see this in Japan, we saw this in the UK budget, we are seeing this all over the world. We are continuing to see a coordination of easier monetary policy and easier fiscal policy, but yet pretty much every country around the world has inflation above target. So central banks are dealing with something that's very challenging. You can't ease financial conditions and boost fiscal policy at the same time when inflation is already above target. So I think the second order effect here is, yes, that is a huge concern that the bond market is going to have a significant impact on whether or not the equity market can trade as exceptional as many are going to expect and extrapolate it to. That is, again, not the first order effect. That is, again, maybe a story that comes through in the second half of 2025. But that is something that we're going to be focused on a lot, given that, again, you can't get as much growth as you want. You can't deliver as unprecedented fiscal stimulus and not have to worry about inflation. Inflation is going to be the major driver of the FX market starting in 2025.
Mark, the former president, though, has talked about the fact he wants a weaker dollar. Is that at all any chance in the cards for him?
There's an old saying, don't tell me, show me. I would say there's again, the second order effect, I think, is actually quite interesting because everything that's happening now as we're talking about the trading theme is U.S. exceptionalism. And again, the dollar should strengthen. Would not be worried that dollar positioning is long right now. This is a bit of a game changer. I do see the ability to weaken a dollar through a couple channels. First one being striking a deal. What does Trump want and what does Trump need to deliver on? They need to deliver on industrial policy to the states in the Rust Belt that want to see manufacturing come back. One way that you can do that is through a weaker dollar. The other way you could do that is by basically revaluing and trying to figure out how to get Asian currency stronger. So there could be a deal made in 2025, 2026, stronger dollar or weaker dollar, stronger renminbi, stronger yen, stronger Korean currency, all these currencies that are extremely cheap on our models, which would be a way to see the dollar go lower.
Hey, Mark, we got to go. It's good to see you. Mark McCormick there of TD. Up next, Mohammed El-Erian of Queen's College, Cambridge, Libby Cantrell of PIMCO, and the former Kansas City Fed president joining us as well. President-elect Donald Trump. Check out these moves. If I told you, and you hadn't seen this, and I told you that the Russell was higher than it is right now, a little bit earlier, by a fair bit, you probably wouldn't believe me. We were up by more than 6% earlier on this morning. We're now up by around about 5%. On the S&P 500, equity futures up by 2 full percentage points. But we're seeing some big moves in the bond market. 2-year, 10-year, 30-year, higher by 20 basis points. On a 10-year, up by 23 on a 30-year, 446 on 10s. And in foreign exchange, the move you're seeing in euro, 2 full percentage points against the dollar, 107.10, the biggest move going back to spring 2020 on euro-dollar.
And on track potentially for the biggest move going back to 2016. Here's the question. How much does this stick and how much is this just basically a knee-jerk lean in to basically an exaggerated 2016 trade? And that, I think, is one big question, especially with the bond sell-off. This is a different moment than it was 2016 from a deficit perspective, from a stimulus perspective, as well as from a growth perspective. At what point do yields become self-limiting to some of the risk rally that we see absolutely tearing through markets?
I want to pick up something Romain Bostic said out of Michigan. He's really drilling into what went wrong in this state. Alyssa Slotkin left her district, Michigan 7, to run for the open Senate seat. Double whammy. Not only has that seat flipped red, but according to Romain, she is on course to lose the Senate. A double whammy for Democrats when it comes to that congressional district and the Senate. And that is just basically foreshadowing the entire, not just looking back at the evening, but what potentially could come for the House races.
It's a beating, that's for sure. If you are just joining us, welcome to the program. We begin with our top story. Donald Trump heading back to the White House.
I want to thank the millions of hardworking Americans across the nation who have always been the heart and soul of this really great movement. We've been through so much together, and today you showed up in record numbers to deliver a victory like probably like no other. This was something special, and we're gonna pay you back. We're gonna do the best job. We're gonna turn it around.
What a comeback. Trump taking the battleground state of Wisconsin and making his return to the White House official. Vice President Harris expected to speak later on today. Joining us now, Mohammed El-Erian of Queen's College, Cambridge. Mohammed, welcome to the program. We've got a lot to work through, so let's get to it. How much does this redefine the outlook from your perspective?
In a major way, John. This is not just a big win for President Trump. This is not just a big win for the Republicans. This is the emergence of a new power structure in the United States. And I think the markets are reacting in an incredibly rational fashion. In fact, if you look at how the markets have treated the last few months, they've done much better than the political scientists in terms of predicting what could happen and then in reacting to what has happened.
I would echo that, Mohammed, because before we even saw any real clarity in the vote, this move started at 7:30 Eastern time yesterday evening and never looked back. Bond yields higher, equities up, small caps outperform. Let's separate this, Mohammed, from asset class to asset class, and we'll just sit on fixed income for a moment. We're higher by 20 basis points. You know this market better than most, that's for sure. Do you see that as a move off the back of a better outlook for growth, higher inflation, a recalibration of interest rates relative to what we thought was going to happen? Maybe they have to stay where they are. Perhaps they even have to consider hiking interest rates in 25. How do you think about breaking this down?
You're going to hate my answer. All of the above. And it's consistent with what's happening elsewhere. So there is an embracement of higher growth that comes from deregulation. There is concern about higher inflation. And there is also a revisiting of the conventional wisdom of the Fed. So all three are playing in. And John, you know, we've now seen an over 70 basis points move since the Fed delivered its jumbo cut on the 18th of September. So there's been massive moves in this market. We're seeing the curve steepen. So it's all of the above. And over the next few weeks and months, we're going to have a better feel for which one's going to prevail or not.
If bond vigilantes are screaming, equity markets don't hear them. And I think that this is one of the big questions. At what point does the rise in yields really create concern about the deficit versus just simply, oh, yeah, by the way, that's just another sign of growth and potentially these other issues, too, but don't worry about it?
But Lisa, two of the three reasons are such that the equity market is right not to hear the bond vigilante, to put your word, screaming, because higher growth is good for equities. Because the Fed not having to cut rates for the right reasons, which is that the economy is doing well, employment is doing well, that's good for equities too. So it's only the third one, higher debt, higher deficit, higher inflation, that they should worry about. But I totally understand what we're seeing in terms of reaction. When I look at markets today, be it at the broader level, at the headline level, or be it in terms of components, they are behaving very rationally.
At a certain point, you have to wonder what playbook we're going to in terms of the economic trajectory. We were playing with no landing, soft landing, hard landing. Before this election, something that nobody noticed was the U.S. Services Index that came out, and it was actually much stronger than expected. I don't want to talk about that. What I do want to talk about is this economy looks like it was on solid footing coming into this. What is your fear that we could see a real reacceleration of both economic growth and inflation that becomes unsustainable?
So let me tell you first what the upside is. The upside is you could get supply side improvements, and you could get a faster productivity boost than most people expected. That is clearly on the cards. So if you remember, there was a third scenario. Everybody focused on is it no landing? Is it soft landing? Is it recession? I kept on saying there's a third one. There's a fourth one. It is bigger but not hotter. And the probability of bigger but not hotter has gone up relative to where it was yesterday. In terms of your question of what can go wrong is that we get the inflation coming much earlier than the productivity improvement. And where would the inflation come from? Mainly the imposition of tariffs. So that's the balance that the administration is going to have to figure out. That's the balance that the market is going to have to navigate.
Yeah, and I think it's trying to navigate it right now. Transatlantic, the divergence we're starting to see. Mohammed, check this out. I've got a German 2-year down 10 basis points. I've got a US 2-year up 11. It's unusual to see things like this take place. And I think trade is the right place to start to have this conversation. The prospect of there being a more inflationary impulse to US policy. And the bottom line being that the Europeans are going to have to eat Chinese overcapacity, take a hit to growth, and the ECB is going to have to cut interest rates. How are you considering the divergence we might see? ECB to Federal Reserve, growth, interest rates, inflation, transatlantic, and what it means for that spread?
Yeah, I remember coming on your show when the market was expecting the ECB and the Fed to cut by the same amount. And I'm saying, what's going on here? These economies are at fundamentally different places. You put it really well in the previous hour when you said the difference with 2016 is that Europe and I would say China are both in a weaker position today than they were then. And that is what the market is feeling, and the market is reacting in that manner. Two things Europe is worried about. One are the consequences, the spillovers from what happens in the US on them, in terms especially of relative performance. And then the other thing they're worried about is the big sucking sound that the US will have, which is mop up even more of foreign direct investment that's on the move around the world. So this should be a wake-up call to Europe to get its act together on productivity, on growth. And they have the Draghi report that tells them exactly what they need to do.
Well, it is a wake-up call. Olaf Scholz already taking to Twitter just 10 minutes ago saying America has voted, but trying to make sure they're putting out that olive branch, that the U.S. and America have this partnership and friendship. Mohammed, what kind of reciprocal measures could we see out of Europe if we are basically heading into potentially a trade war?
I'm less concerned about a trade war with Europe. I'm less concerned about a trade war with Mexico, to tell you the truth. I think that ultimately that these will be negotiated. Where I think there will be more tensions is with China. And you're going to see that across the board. I think at the end of the day, remember, tariffs, and President Trump said it himself, are used also as a weapon to threaten in order to change behaviors. If behaviors change, then you don't have to impose the tariffs. I think China is a completely different story. China today has got some really difficult decisions to make, including whether they are in a position to implement a big stimulus. I don't think they are in a position to implement a big stimulus. And they've got to have to figure out how to navigate this more difficult environment.
Well, that's interesting because some analysts at Goldman Sachs were basically saying they were waiting on big stimulus, waiting for a bazooka, holding back that firepower because they wanted to see whether or not Donald Trump was going to win. But you're saying it's actually the opposite. Why?
Well, they've been holding on to that bazooka for a very long time. And I always start from the assumption that people are rational. So why would you hold on to your bazooka? And the reason why is your bazooka has unintended consequences that you want to avoid. Your bazooka puts on steroid your old growth engine that is problematic and that you're trying to move away from. So there's a reason why for the last 2 years they haven't used their bazooka. This argument is they're going to use an even bigger bazooka ignores the fact that the Chinese government fundamentally understands that it has to move to a new growth model. So I'm not in the Goldman Sachs camp that we're going to see now a massive bazooka because they're worried about what's going to happen in the US. I think they're going to have to accelerate the reforms they need.
If there is no bazooka that comes on Friday after the result, and meanwhile, American exceptionalism in full tilt that isn't necessarily going to bleed over into the rest of the world, there is increasing fear that this leaves the Euro region getting closer and closer to recession. James Knightley over at ING basically saying that just even renewed uncertainty and trade war fears could drive the Eurozone economy into recession as soon as the turn of this year. Do you agree with that?
I think Europe has problems, and I've been saying this for a while, and they really have got to get their act together. Look, they're going to benefit from a positive demand effect coming from the US. So will emerging economies. So there will be a positive demand effect. They will suffer from a negative price effect coming out of the US, and they've got to navigate that. And they're going to suffer from a negative foreign direct investment effect. So there is a positive effect, but it's not big enough to offset the others. This has just made it even more urgent for Europe to move on the sorts of reform that the Draghi report details really well.
Mohammed, we'll miss you tomorrow afternoon when we cover the Federal Reserve decision. I just want your thoughts on that Fed decision. It's going to be fascinating.
Going to be a great press conference.
What do you want to ask in that news conference? What's your number one question for Chairman Powell right now?
It's not going to be answered, but it is how do you think about the election? That is what I would like to ask. I think he's going to sidestep that question, and he's going to wait. And he's right to wait, because he needs to see what actually emerges in terms of policies.
And then in December, they've got to come up with some forecasts. Good luck to them. Mohammed, it's good to see you, sir. Appreciate it. Mohammed El-Erian of Queen's College, Cambridge, with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Bitcoin hit a record high as markets watch votes come in for Donald Trump overnight. The largest cryptocurrency topped 75,000. It's widely viewed as a Trump trade because he has embraced digital assets during his campaign. Crypto-related stocks, those are also rising in the pre-market trade. BMW shares, those on the other hand, falling in the German trade, down 6%. It reported its main measure of profitability had fallen to the lowest level in more than 4 years. BMW's costs have risen from a faulty braking system, which forced it to recall as many as 1.5 million cars. It's also dealing with faltering demand in China and Europe. Apple is set to face the first ever fine under the EU's new digital antitrust rules for big tech. According to people familiar with the case, watchdogs are readying the penalty levied on the iPhone maker for forcing app developers to stay within its Apple App Store. Just months ago, Apple was hit with a $2 billion fine for similar abuses under the bloc's traditional competition rules. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Trump 2.0.
We're going to make our country better than it ever has been. This is a great job. There's no job like this. This is the most important job in the world.
And it's shaking up this market worldwide. From New York City, that conversation up next. Good morning. Number 45 becomes number 47. Donald Trump, president-elect. And these are some of the moves you're seeing off the back of that decision by this nation. Check out this rally in the pre-market. JP Morgan higher by 7%. Bank of America up by 7.6%. Citi up by almost 8%. Under surveillance this morning, Trump 2.0.
We're going to make our country better than it ever has been. The task before us will not be easy, but I will bring every ounce of energy, spirit, and fight that I have in my soul to the job that you've entrusted to me. This is a great job. There's no job like this. This is the most important job in the world.
So here's the latest. Stocks surging and treasuries tumbling as Donald Trump wins another term in the White House. Libby Cantrell of PIMCO writing in terms of the collective economic impact for Trump, given a president's unilateral authorities over tariffs, there are more risks from both an inflation and growth perspective as it relates to tariffs. Libby's back with us. Never really left, Libby. It's good to see you again.
So nice to be here within 2 times within 12 hours.
Good
Lucky
morning.
me.
It's good to see you.
Nice
Let's
to see
talk about what we can take away from last night.
Yeah.
Your big takeaways.
Well, look, we have been characterizing this as a knife fight in a phone booth between the two candidates. This was a knife fight, maybe, but he brought a machete and she brought a butter knife. I mean, this was a resounding win for former President Trump. The Senate looked like it was going to flip regardless, but looks like Republicans are doing better in the Senate. Open question in terms of what kind of majority they have in the House. They probably will keep the House, but by a narrower majority than what they had when Trump was first president. So remember, when he was first president in 2017, he had about a 25-seat majority in the House. He may only have a 5-seat majority, and that may, eyes may glaze over, but that's actually quite important when we talk about tax policy, when we talk about spending and what have you.
When you look at, though, his outperformance from his 2016, 2020 numbers and how Kamala Harris was not keeping pace where Joe Biden was in 2020, this feels like a mandate for him.
And I think that's right. I mean, and of course, going back to just the tariffs, I mean, he can do a lot from an economic perspective unilaterally. He does not need the Congress to impose tariffs. We already know that from Trump 1.0. In terms of immigration, he can do quite a lot. So will this embolden him in terms of, advancing that agenda unilaterally? Absolutely. It just comes a question of what can he get through a narrowly united Congress. Again, he'll have a bigger majority in the Senate than I think, most folks had expected. And that bodes well in terms of who he wants for the Treasury, who he wants for Fed, who he wants for other.
That's what I want to talk about. In Washington, D.C., personnel is policy. This morning, Dan Ives, Lena Khan, out ? The biggest thorn in the side of big tech has been the head of the FTC. Where do you see these kind of positions stacking up? Who does he go to?
Yeah, so Lena Khan is very likely out. Her term, of course, expired several weeks ago. So she is basically a lame duck. So he will just have to nominate somebody and, of course, get them confirmed. That one shouldn't be a problem. Similarly, the CFPB is out. The FHFA is out. So some of these other independent agencies like the Fed, very unlikely he can fire Powell, for instance. But for the CFPB and the FHFA, he can usher change just given the structure of those agencies. So again, there will be a big change, even just from a regulatory perspective. So even when we're not talking about legislation or spending or tax policy, what he can do unilaterally is going to be pretty significant.
So basically, you think that a base case is a red wave, but it isn't necessarily as red as it was. So it won't necessarily be as much of a mandate. What is the main question you're hearing from clients right now?
We haven't heard from any of our clients yet. I've heard questions from our traders.
What are your questions from traders?
Of course, around the night. Well, I mean, we were talking about this last night, too. The curve has steepened a lot. And I think, our view on this in some ways is that the curve should have steepened regardless of who won, just because that they were both going to be bad for the deficits. I think you can argue, and this is a nuance here, so just give me some time, that actually with a Republican sweep, and I'm not sure you call this a Republican wave, but definitely a strong Republican sweep, there could actually be more offsets to a tax bill than there would have been if he had had a divided Congress. And what do I mean by that? You could get pay-fors in terms of rolling back some of the Inflation Reduction Act, sort of scaling back some social entitlement spending. So you actually could get I just don't think this idea, the sort of narrative in the marketplace that he's going to be as bad much worse for deficits under a Republican Congress is necessarily justified.
But there is this question about the cutting, right? And sort of Elon Musk's role in all of this. I think of sort of the Elon Musk proxy as Tesla is surging. And I think about that $2 trillion of budget cuts, basically slashing the government by a crazy amount. Is that crazy or is that not crazy? Is that something that people are looking for?
Yeah, so that is, I'm not sure if it's crazy or not crazy. It's more unlikely just given where the Senate is. And again, even though he has a pretty commanding majority in the Senate, likely, he will not have 60 votes. And this is actually quite important. The filibuster is not going away. You still need 60 votes for most spending bills. So all of the things that Elon Musk was talking about, for instance, would go through an appropriations process. You need 60 votes for that. He won't have that. So could you see maybe some deficit reduction at the margin? Maybe, but it will be very difficult to do something it's significant like that. You just won't have the votes in Congress.
Libby, I want to go back to the polling, only because you actually nailed this, even though you were shying away from it last night. You had said in your notes, and I'm paraphrasing here, but you had said for quite some time, if polling is correct, Trump wins. So polling was, in a sense, to your mind, do you think accurate?
Yeah, yes. I mean, I think that polling was, and I think what we were talking about is sort of this idea of maybe a systemic polling error, whether it was a 2020 or whether it was a 2012. 2012, of course, went in favor of Democrats. 2020 went in favor of Trump. And this was much more a 2020 election for sure. I think that polling more or less got this right? Polling was within the margin of error. Trump absolutely did better. He outperformed where he was polling, but again, within that margin of error. So pollsters probably feel okay this morning. This was not a miss like we saw in 2016, for
Queen
instance.
of polling, though, and
Queen of polling, she was wrong.
So let's talk about the women.
Yeah,
let's talk about this potential pink wave.
Those women did not happen. Those women. We were just talking about. Those women turned up. They just turned out for Donald Trump. So I mean that is I think the thing. I think the sort of what she saw, the tea leaves, and she's been pretty good about identifying some of these national trends historically, not this time, is that those suburban women never broke.
Where does this Democratic Party go from here?
I mean, that is going to be an open question, and I think it's probably too early for sort of the recriminations and. But I think you're already sort of seeing it on Twitter at least. But I think we'll just have to see the dust will have to settle. I think that folks will be very focused on what 2026 looks like. As you know, the Senate map is actually, not that we should be talking about another election, but 2026, the Senate map is actually bad for Republicans. So I think you're going to try to see a Democrats running candidates who can actually win. I mean, the country has spoken. We are a center-right country. And I think for Democrats to be able to compete in these sort of centrist, purplish states, they're going to have to field candidates who can appeal to that.
I wonder if that's the message they receive. Because the people I'm focused on over the next few months are the people who've been quietest, who might become the loudest. Progressives didn't complain about anything, didn't pin Harris down on unpopular things, didn't remind her of what she committed to back in 2019, the press tried. I just wonder how forceful they will be in the next few months, how angry they will be, because ultimately Harris tried to run as a pragmatic moderate, did she not? And it didn't work out.
Yeah, I mean, I think again we didn't really know exactly what platform she was going to run on. I mean, I think there'll be a lot of Monday morning quarterbacking.
Well, we're doing it right now.
I'm just not sure, honestly. If she had picked someone, say, as a running mate who's even more progressive than Tim Walz, and Tim Walz was more progressive, right? He's more progressive than Josh Shapiro. I think that was sort of.
Should she have not chosen Josh Shapiro? He's beloved by Pennsylvania. Again, the one state you have to win.
Yeah. Again, a lot of Monday morning quarterbacking here. However, I'm not sure if it really would have made a difference at this point. I mean, he just did. It's just you look at the rightward shift across the country, and maybe picking Shapiro would have helped marginally.
Well, what would have made a difference? Should Biden have dropped out after the midterms, opened up a primary, and actually maybe the Democratic Party could have picked someone who can untether themselves from the White House?
Do you think a moderate would have come out of that process? Do you think a moderate would have come out of that process?
It's a great question.
If they'd had a primary? Give me a break. There's no way that party is going to select a moderate.
You're right, but the one thing that person potentially could have happened, if it was Kamala Harris, she would have been a better candidate. Maybe you wouldn't have the View gaffe. Because guess what? To go through a primary, you become a better candidate. Or they would have gotten somewhere, maybe, Libby, do you think, that could have put some distance between them and Joe Biden?
Maybe, but I just also think, the big issue, and we've been talking about this for months, is gas and groceries. It was gas, groceries, and rent. This was a huge headwind for whomever the Democratic candidate was going to be. I mean, I agree, you could say, what would the primary process would have fielded a better candidate? Maybe, maybe not. But there was a huge incumbent headwind. Yeah. And I think maybe the knock on her was, or Biden, was maybe not recognizing just how inflation has basically been a regressive tax for voters across the country.
Libby, we got to go. Equities right now on the S&P 500 up by 2%. On the small caps, the Russell up by 5.9. On the Nasdaq, up by 1.5. Just a phenomenal rally off the back of the nation's decision to give Trump a second term. In the bond market, it means we're selling bonds and yield to higher across the curve. Up by 20 basis points on 10s, up 23 on 30s. And just compare and contrast what's happening in the European bond market. 2-year in Germany, down 9 basis points. Lisa, the 10-year unchanged on the session. Very different picture.
There's a feeling that the Euro region will be hurt disproportionately by what happens by the United States, by the Donald Trump administration, and that, frankly, the ECB should be cutting rates more aggressively to offset that weakness. What you see in currency markets just tracks that with the complete plunge. At one point, the most since 2016 in the euro versus the dollar. Here is the question. How much of this sticks? Do we start to see policy that actually underscores this going forward? Or is this something that's going to be considered, in retrospect, a dislocation?
You said at one point, we're back to those levels right now. So euro dollar down by 2.1%, the biggest move potentially since June of 2016, June 24th. You remember that date well? That was the Brexit fallout. Euro dollar negative 2%. A break of 107.
What's interesting, and Mohammed El-Erian really pinpointed this, essentially this is the same seismic shift in global reordering of power that you could look back to the Brexit vote or potentially even more. And that's really what markets are trying to sniff out right now. And you can see that across the board. You can see that with the dollar stronger across the board, not just against the euro, but the Mexican peso as well with respect to tariffs. And I think that's what people are looking at. What is the new world order and how does it really play into markets?
The peso move is painful. Dollar Mexican peso up by 2.8%. Under surveillance this morning, Donald Trump winning another term in the White House, the former president flipping key swing states Georgia, Wisconsin and Pennsylvania. There was just a feeling overnight that this was done and dusted and pretty quickly.
Or yes, definitely so. And the reason more for that is because Donald Trump was outperforming his 2020 numbers and Kamala Harris was underperforming in key counties where she wasn't even matching what Joe Biden was getting. So you saw the strength almost immediately in the Sun Belt in places like Georgia. Then he grabbed North Carolina and then, of course, winning Pennsylvania. It's all over. When it comes to what Libby Cantor was talking about, we have to still wait on the House. But when it comes to potentially this mandate, Donald Trump's speech last night definitely felt like he had a mandate because the fact that he's winning the popular vote, because the fact that he overperformed last night certainly feels like 2016 when it comes to this market.
It certainly feels that way in a big way, particularly looking at small caps absolutely flying. Let's talk about the Senate. Republicans winning control of the U.S. Senate, giving the party powerful leverage ahead of high-stakes tax and spending battles next year. The House is the Democrats' last hope for power, with the party needing a net gain of 4 seats to take a slim majority from the GOP. This was a high-conviction call, relatively speaking, for most people, that the Republicans would take the Senate, but they've taken a bigger lead than many people thought.
Exactly. The conviction was they take it. The question was by what margin, and we still don't know yet how big the margin is going to be. I'm looking at these races in Pennsylvania, whether or not Dave McCormick of Bridgewater can unseat someone like Senator Casey. Potentially that margin is going to be bigger. When it comes to the House, though, beware, this could take time because some of these absentee ballots out of California could take days, maybe even a week or so.
Libby Cantor was really brilliant on this when she basically said it sounds mind-numbing, but it matters incredibly for just how much we can really count on the deficit getting bigger. Because essentially, if you start to have a narrower majority, even if it is a red sweep, you don't necessarily get the same mandate or composition that Donald Trump had in 2017 when he took the office last time. That is what I'm watching, not just simply the color of the overall majority.
The bond backdrop is so different compared to 2016. I think we have to keep repeating this as well. The difference is now, between now and then. In 2016, this market was hungry for fiscal stimulus. We were talking about this all the time. The only game in town was the Federal Reserve. We needed to see more from the government. They needed to spend more. That's not where we're at right now. We're in a very different place.
To me, this is the key question, and I think it's fascinating for the economy. How much are we seeing productivity gains? How much are we seeing an acceleration of a recovery that we already had? And how much does that sustain risk assets at a time when bond yields used to be thought unsustainable at levels we're currently seeing can keep going? And that, I think, is one of the key existential questions behind some of the moves we're seeing.
Mohammed El-Erian nailed it yesterday in the FT when he quoted JFK. When it's times of sunshine right now, when the government has that time of sunshine, when you're at U.S. exceptionalism, you start fixing the roof. You don't dig deeper into holes. And when you look at these campaign promises, potentially when it comes to the fiscal deficit, you are digging deeper into holes.
Running a budget deficit of 7% when unemployment's around 4%. We've heard complaint after complaint about that over the last few years.
Okay, I'm not going to beat my drum, but just to quickly give you a little taste of it. I mean, basically, interest rate payments on the U.S. government debt more than tripled over fewer than 4 years. If you take a look, $900 billion of interest payments for this year, you start looking out, that goes up and to the right, significantly, especially if these yields are sustainable.
Beyond the election, we get a Fed rate decision tomorrow. That'll be interesting. The market widely expecting a 25 basis point rate cut. Donald Trump sharing his thoughts on the Fed chair just last month.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do? I think that if you're a very good president with good sense. You should be able to at least talk to him. I don't say make the decision at all.
Joining us now is the former Kansas City Fed President, Thomas Hoenig. Thomas, welcome to the program. The former president, now president-elect, says it's one of the easiest jobs in Washington, D.C. Is that job about to get a whole lot harder?
It's going to be harder, but not all that much harder. All these issues were there, whoever was elected. So I think that continues to be their challenge. And their challenge is, as you were just saying, there's a huge deficit. There's a growing debt problem, and the Federal Reserve is unwilling at the moment to speak out and say that is, if you keep that up, we're not going to be able to control where interest rates go, and that is a major problem for any politician. So I think the problems are only going to get more acute, but not necessarily different than what they would have otherwise been.
Thomas, walk us through the process at the Federal Reserve. You've been there. I think we all want to understand what the December meeting will be like. Not this one this week, but in December when they have to put out projections. This market's already making a projection on things like growth, on interest rates and on inflation for the next year and maybe even beyond. How stale would the Fed projections look in December, given that they have to look at campaign promises but can't do anything with it until it becomes legislative reality? What do you do with that at the Federal Reserve?
Well, remember, those projections are based on what they think will happen, and if they think that the deficit is going to get worse, some of the members will take that into account, and you would see, I think, a change. I think the ones that I just did will be stale. I think you will see a less decline in interest rate, other than the pressure they're going to feel to lower interest rates. But I think it'll be a very difficult period for the Fed to try and outline what the future lies in terms of their dot plots. So I think it's a matter of degree. It's hard for me to say whether they're going to do one thing or another, but I think basically they should show a less steep decline in interest rates going forward, because the debt. I mean, you have to look at what's been promised. I mean, we got tariffs to deal with. We have extension of tax cuts to deal with. That all has impacts on the long-term debt, and that has impact on what the Fed can do with interest rates.
Thomas, how much already is just the move that we've seen in longer-term yields a real warning signal to the Federal Reserve, enough to really curtail any further rate cuts beyond this year?
Right. I think the market is saying that the debt is going to be a major problem. You are not going to be able to control that, even though there'll be a lot of pressure on them to buy that debt to keep interest rates lower. That means inflation. The market knows that, and that's their signaling. What I don't understand is, I think the Fed carefully, but should be making the public more alert to their limits, to the Fed's limits, if we don't get the debt under control.
Let's talk about those limits, Thomas. You were at the Federal Reserve during the financial crisis, during the initial rounds of quantitative easing, where the Federal Reserve did exercise its ability to monetize the U.S. debt. And I'm wondering how high that bar is to do that again if certain people are put into the Federal Reserve, onto the Federal Reserve by Donald Trump to potentially buy more debt, expand the balance sheet, offset some of this increase in issuance.
Well, I think that will be the pressure, because if you don't do that, with the amount of debt that has to be put out there, there's going to be enormous pressure on the Fed to buy that debt, or the rates will continue up. I mean, that's just the fact. And so that pressure will be there, I think, extremely so. But the problem with that is they're supposed to be independent to say no to that and to alert the Congress that that kind of spending and that kind of debt cannot be sustained. And therefore, the Fed is not going to monetize that debt. In a crisis, yes, the Fed will monetize it. But the question is, will they stop doing that as they should? In their recent history, the last 15, 20 years, they continue their monetary easing well past the crisis. And that enables the Congress to continue to spend without constraint, and therefore the debt continues to grow. So the Fed has to say, we're going to put an end to this, and that is going to be one tough job for any Fed and any chairman of any Fed.
Thomas, if they don't do that, what's the potential consequence? I know you said inflation, but can you give us some sort of range of potential outcomes if there is a greater willingness to monetize some of this debt?
Well, first of all, I think people tend to focus on consumer price inflation, but what is going to happen is asset inflation is going to reignite even beyond what it is today. And you think a house is unaffordable today? Well, look at what's going to happen when they monetize that debt and asset prices go up. The stock market will go further up. The divide between the haves and have-nots will grow in the United States. The Fed has to know that, and that's why they have to put the alert out in a very prudent way. These things can be highlighted by the Fed. That's part of its responsibility because it's limited in terms of what it can do with a full yield curve under these circumstances of debt growing at these kinds of rates.
Thomas, this was super thoughtful. We appreciate your time. Thomas Honig there, the former Kansas City Fed president, on the outlook for the Federal Reserve. Adam Posen in the Financial Times earlier this year, late summer. Chair Powell should make it clear that the Fed's monetary policy stance could reverse after the election, even if it sets up rate cuts in the coming weeks. He should also remind markets and households of basic economic realities. The argument that Adams made over the past few months is that they should take a page out of the playbook from Governor Carney at the Bank of England. Now, I would caution that once you start playing that game, even if you believe it is sound, economically sound to make these points, you attract the wrong kind of attention when it comes to things like political independence.
I was just about to say that. If he stands up on that podium and he says, well, we don't delve into political issues, but then he starts to give a warning about just what those consequences could be, then all of a sudden he takes a page from Carney. All of a sudden people are saying, what do you think you're doing? And so it's a very slippery slope. Here's also the issue that we've seen time and time again. The Federal Reserve is not the Bank of England. The U.S. economy is not the British economy. And I think that they're going to have to grapple with and walk this fine line between independence and being economically prudent at a time where we do not have clarity on what economic policies will be.
We're going to be in a really strange place with the Federal Reserve for the next few months. They'll be on a planet over here, and the market's going to be on another planet over here. And we're seeing that play out right now. The market's already taken a view on rates for 2025, away from the Federal Reserve. And the Federal Reserve is not going to be able to talk about it for months.
I remember, I'm old enough to remember, when the Fed worried about tightening of financial conditions. Right now, they don't have to worry about tightening of financial conditions, but they have to reflect that. Why is that happening? At what point does that become a constraint? And if it's not a constraint, at what point does that indicate a much higher terminal rate? At what point do they have to reflect the fact that markets are showing a different economic reality than they were, say, even 2 weeks ago?
Bonds down, yields up. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Some earnings for you. CVS shares are rising in the pre-market 8.9%. Third quarter revenue came in over 6% higher than a year earlier. CVS, though, opted not to give investors guidance for the remainder of the year or for 2025. It did announce a new president for its troubled Aetna insurance unit, facing headwinds on rising costs and decreased government payments. CVS shares have fallen 30% so far this year. Amazon co-founder and executive chair Jeff Bezos sold over 213 million of his shares of his company, according to an SEC filing. Amazon recently reported third quarter sales that surpassed expectations, an 11% increase from a year ago. Bezos has sold more than $13 billion in Amazon stock this year. And world leaders have congratulated Donald Trump on securing a second term in the White House. Ukraine's Volodymyr Zelensky congratulated Trump on an impressive election victory. French President Emmanuel Macron said he was ready to work with Trump again for 4 years. Leaders from Germany, Israel, Australia, India, and the UK also offered their congratulations to Trump. And that's your brief. John.
Danny, thank you. Jemana covered this a little bit earlier. What did Ukrainian bonds do? Rallied.
Yeah, exactly. And so there's this question of, do you get some sort of resolution to this sooner? I mean, the fallout effects from this are massive. And some of that was actually a move that was a bit counterintuitive, I think, from what some people were expecting.
Seismic changes potentially. That was the words of Mohammed El-Erian, I'm paraphrasing, but ultimately the message from Mohammed a little bit early this morning, about 40 minutes ago. Next on the program, a big repricing in the bond market.
The 10-year Treasury right now is above that fair value estimate. So for me, it's not a done deal that a red sweep results in out of control spending.
That conversation up next, live from New York. You're watching Bloomberg TV. Mornings like this are really rare. Stay tuned. Check this out. Up 2.4% on the S&P 500. In the FX market, a move we haven't seen on the euro going back to 20 16. It's a break of 107, 106.90. In the bond market, yields a whole lot higher, up 17 basis points, 4.44. Under surveillance this morning, a big repricing in fixed income.
We had to reprice for higher growth, maybe for some higher inflation expectations, and maybe for less rate cuts. But we've done that. The 10-year Treasury right now is above that fair value estimate. People worry about what does a red sweep could potentially mean for budget deficits. But I think there are a lot of Republicans in Congress that actually do want to rein in budget deficit. So for me, it's not a done deal that a red sweep results in out-of-control spending.
So here's the latest. Treasury yields surging to 4-month highs as the bond market braces for Donald Trump's return to the White House. Joining us now to discuss is Vishy Tripator of Morgan Stanley. Hey, Vishy, welcome to the show, sir. What a move we've got in fixed income to start this conversation with you. I want to understand, first of all, have you changed your mind about anything in your outlook for fixed income based on the results overnight?
I think we are processing, I would say the best thing to say is that we are processing a lot of the change that's happened and still awaiting whether it will be a red sweep or not. That's still we are processing. I think the thing that we are spending the most time thinking about really is sequencing of policy. So we had imagined that under a red sweep scenario, what are the potential things that could happen? We would think about I would put that in sort of 3 buckets. Tariffs, immigration, changes to immigration policy, and changes to tax policy. I think a lot of the conversation you've just had focused on the deficit expansion and the tax policy. We think that actually takes time. Even under a red sweep scenario, legislation is a messy process. Lots of interest groups are involved, lots of details, and we still don't know it's a red sweep or not. But even in the red sweep scenario, we think the thing that could happen most immediately are the tariffs. It's consistent with the first term, what he did in the first term. It's consistent with the campaign messaging through the entire campaign. And it's something that does not require a congressional approval. So we think really sequencing-wise, we think will be the first order of impact. So are we going to see across the board all the tariffs? Are we going to see some tariffs that actually grow over time to, say, 60% for China? We don't quite know yet. And those are the kinds of details I think the market will have to come to terms with, and what the potential impact of tariffs would be on the economy and on inflation. And before really digging into the effect on the deficit expansion, which will still, as I said, still take time.
Well, let's pick up on that last point. I think we can explore guardrails and regulating forces. Vishy, do you think that this bond market will act as a regulating force on the tax cuts, hopes and dreams of the Republican Party?
To be honest, we don't know. We think it's possible that we've seen the bond markets do some of this in other countries. Clearly, we've seen that happen in the UK. But I think the bond market will have to evaluate what the effect of this on both on inflation and on growth from tariffs, and how do that interlink with the deficit expansion under the new tax policy. I don't think the market quite knows this yet. I think the market will have to come to terms with these competing issues, and that is going to take some time. So I would consider some of the knee-jerk reactions that we are seeing may get reevaluated.
Vishy, the real issue to me is that you say the knee-jerk reaction needs to get reevaluated, but the knee-jerk reaction is fascinating in that even this massive climb in yields at the long end has not at all diminished the trade that we're seeing in small caps, in bank stocks, in across the board, some of the more pro-cyclical aspects of risk assets. And I'm just wondering whether we have to rethink what a neutral rate in this society is and this economy currently and the trajectory that it's headed on.
I won't push back on that. I think we have to rethink a number of things, including what you just said. I think how do we price in the animal spirits, and how do fixed income markets react to that? So I'm thinking as a credit person primarily, I'm thinking in terms of Credit likes moderation, and what we may end up having is more than moderation. And if we have a high level of if interest rates or yields stay elevated, that will start putting some pressure on the parts of the market that some of the interest coverage ratios, et cetera, will be challenged. So the way I'm thinking about this is that how do animal spirits play out in the bond market? It's not entirely clear at this point, but I'm a little concerned that from a credit investor perspective, animal spirits may benefit more of the equity investor versus credit investors.
Interesting, especially at a time where potentially there are certain companies that haven't yet refinanced. But that's what I want to ask, Vishy. Haven't we basically just stress tested all these companies? Aren't they going to be able to manage through? Haven't we seen that?
Yes, we have seen that. But we have seen that in two different ways. I think if you've seen the fixed rate borrowers, whether it's investment grade or high yield, we have not seen a lot of the pressure testing into those companies because they had issued a lot of debt in 2020 and 2021. So they didn't have to deal with a lot of pressure on their higher interest expense. That didn't really show up because they're fixed rate debt. That did show up. Where it did show up was in floating rate borrowers, leveraged loan borrowers, where we did see the effect of higher rates really put pressure on rating downgrades, interest coverage ratios, and defaults, et cetera. So we have not seen the fixed rate borrowers experience that incremental. They have not been stress tested in that sense because they had locked in higher level of rates.
I think for a lot of us still staying awake, Vishy, we've all been stress tested for the last 12 hours. Got to leave it there. Vishy, thank you, sir. Vishy Tripatur there of Morgan Stanley. I want to make an observation. It's not a forecast, OK? It's an observation. It's not a forecast. What we're seeing in the market right now, let's start with what we're not seeing. Yes, we should be talking about deficits and whether it will constrain what's happening in the bond market, the hopes and dreams of policymakers in Washington. But I don't think you're seeing that fear around the deficit. And I'll tell you why, and I can point directly to foreign exchange. The dollar's stronger, like really strong. I think the point you can make purely from an observation, looking across markets right now, is what we're seeing evidence of is a positive growth shock. In the United States of America specifically, small caps outperforming, financials rallying, yields higher across the curve, including at the front end.
I would completely agree. I think in addition to the currency, you can also say the Russell 2000. That typically has underperformed when yields went up. This time around, it's the opposite, and that really points to what you're saying.
We'll see if it sticks. It's just an early observation and certainly not a forecast because I'm not in the business of providing them. Up next, the man who is, Jay Pilowski of TPW, Bloomberg's Ed Ludlow, Torsten Slok of Apollo, and we'll catch up with Gennady Goldberg of TD. From New York, this is Bloomberg. The financial market price action worldwide is absolutely gripping. These are moves cross-asset. Collectively, you only see a few times every decade, and it's playing out this morning. It looks like this. Equity futures on the S&P 500 up by more than 2%. Small caps up by more than 6%. Regionals, some of the major players on Wall Street, the financials doing really, really well in the pre-market. Here's some of the why. In the bond market, repricing yields a whole lot higher, up 18 basis points on a 10-year, 4.45, up 8 to the front end. With that, some dollar strength for you against the euro. Euro dollar breaking 107 a little bit earlier this morning. Lisa, down more than 2%.
I think you nailed it at the end of last hour when you said all of this together looks like the pricing of a growth shock more than, say, something else. And I want to build on that. There seems to be this feeling that higher yields will not curtail the risk-on feel in markets, that higher yields will not curtail the idea of American exceptionalism, and that higher yields will not stymie American borrowers from going out and continuing to borrow, which is the reason why regional banks are actually doing better than expected because of deregulation. You put this together, what's going to stick will really depend, frankly, on the actual policies that people come in place and the margin that we still haven't learned
in the House of Representatives.
We're still waiting on the composition of Congress. Is it a trifecta, or is it just 2 out of 3 for the Republicans? Conviction call going in from a lot of people was there was going to be a red Senate. The margins were potentially still waiting on how big is the margins they're going to be, that wiggle room the Republicans will have in the Senate. But what happens with the House? And this is going to take days, maybe even a week or so, depending on California. But the market and everyone is definitely talking about at least Trump got a mandate. Why? He's on track to win the popular vote. The 3rd time a Republican presidential nominee has done so since 1988.
The pieces of the puzzle coming together. If you're just joining us, welcome. We begin with our top story. President-elect Donald Trump.
I want to thank the American people for the extraordinary honor of being elected your 47th president and your 45th president. This was a movement like nobody's ever seen before. And frankly, this was, I believe, the greatest political movement of all time. I will not rest until we have delivered the strong, safe, and prosperous America that our children deserve and that you deserve. This is a magnificent victory for the American people that will allow us to make America great again. It's time to put the divisions of the past 4 years behind us. It's time to unite.
Trump clinching the battleground state of Wisconsin earlier this morning, sending him over the required 270 Electoral College votes to seal a return to the White House. Jay Pawlowski of TPW Advisory is back with us. He was with us, 6 hours ago, Jay? It's good to see you again.
It's nice to see everybody.
I feel so bad to start with this, but you made a really bad call on this election. Harris landslide. What went wrong?
Well, thank you, John. I appreciate that. It's a nice way to start the conversation. Always love that.
No elephants in the room here.
Well, look, right. I mean, my thought is it's a good thing we're not paid to be political prognosticators, because we were of the view that the Democrats would win. Women vote, abortion, youth vote, etc. None of that really materialized. And what's really interesting after a few hours of sleep is the idea of good economics has turned into bad politics for the Democrats, right? The Biden-Harris administration, best economic outcome in generations. The U.S. is the envy of the world, best growth, lowest inflation. And the Trump policy mix, which I think economically speaking is going to prove to be not very good, but was clearly good politics. And so as an investor, here we are sitting. We need to think about exactly what we just discussed. You know, is it going to be a sweep? Because that means the policy mix, more of it is likely to materialize. If it's not a sweep, then we'll see how it all plays out. But I think for us at TPW, we're focused on a long cycle opportunity, good global growth, good risk asset opportunity, and a lot of that depends on policy continuity. And I think what we're going to have in the U.S. is clearly policy discontinuity, and the question is going to be, how does that play out? And the setup I'm thinking about, like right now, this morning on the way in here, was you have the U.S., which is an over-owned, expensive asset. Foreigners have never owned more of U.S. financial assets at a time when the policy mix is deteriorating versus, for example, China, which is a cheap asset, under-owned, just to finish, cheap, under-owned, and arguably the policy mix is improving. City Economic Surprise Index turning up, PMIs above 50. And I think we're going to see at the end of this week a further policy response by China, because they understand that their growth right now is export driven, and with tariffs, that could be a big problem.
I wasn't trying to interrupt you, but before we get to China,
I don't like that.
Don't interrupt you.
John can criticize me, but no interruptions.
He hasn't slept. I've wound him up. So I'm ready to go.
It's okay.
All right, it's a third down and fourth down. How much do we need to get?
There's a question.
Give it a vote.
There's a question here about whether you then fade this move. If you believe that actually this is not the right policy, do you put your money where your mouth is?
Well, that's a great question. And I thought about that. And tactically, I think you have to enjoy the bounce, right? And the reasons are multifold. First, seasonality. This is the best 3 months of the year for stocks. Positioning is pretty light, right? You're seeing that play out. Right? You don't have 5% moves, 2% moves in the S&P if everybody's already long. So people de-risked. Now they have to re-risk. Technicals are supportive. And importantly, most importantly, fundamentals are supportive, right? We're just coming out of Q3 earnings. They were double what the expectation was going into the earnings season. The projection was 4%, ended up being around 9%. And most importantly, I think we've seen a complete collapse in the VIX. That's what needs to be up on these charts here for Bloomberg, right? The VIX has gone from 25 to 15 in a matter of hours. And
2 hours on TV last night. He's producing now.
I need a new job, John.
I want that up on the screen. Let's go.
I need a new job.
Political forecasting, he's producing.
Yes, exactly.
You got some sleep.
Something's got to work.
Now you think you could just take over. So your tripolar world, even though your political conviction was wrong, your market conviction, in a sense, was accurate.
Yep, exactly, it goes back to what I said last night. Remember my mea culpa, I think it was 12:50 last night, was, look, do you want to be, the old market saying, do you want to be right or do you want to make money, right? And I struggled with that for years because my background is a sell-side strategist, and so you want to be right. Really important as a sell-side strategist. As an investor and an advisor, we want to make money. And so we're fully invested. We're long equities. We are completely out of treasuries, so this treasury move is not affecting us in any way, shape, or form other than helping us beat our benchmark.
What would it take to get back in?
Yeah, that's good. That's, again, the question to be asked, I think. And, it's a little tempting tactically, again, because as I said last night, going into this week, the long end of the treasury market, as represented by ETFs, was massively oversold, right? The RSI, Relative Strength Index for the 7 to 10 year ETF, IEF, was 15. They don't really get down around 15 very often. So tactically, I think you're probably, I wouldn't be a seller if I were as an owner of treasuries right here, the long end. But I think the bigger question is the deficit. And clearly, again, the Trump policy mix, it's not just my point of view, pretty much every independent person who looked at it or group, Moody's, Goldman, Peterson, et cetera, it's bad for inflation, it's bad for the deficits, bad for rates, and theoretically should be bad for growth. But I think there's an idea that this is going to be a hothouse effect, which is what you guys have been talking about.
So what are you looking for to decide whether or not to bite the bullet, sell stocks, buy bonds?
Part of it is to see the makeup of the house. Is it a trifecta? Part of it is to kind of like see what China does, right? Because there's going to be a response. We're global, we're multi-asset. So we have the whole world as our oyster, and there are going to be opportunities to play. I think for now, as I said, we enjoy the bounce, we enjoy the ride, and we think about, at some point maybe lightening up, I think, for the U.S. I think the call for us is going to be, if we really do believe in the tripolar world, competition between China, the U.S., and Europe. China has taken the high ground in the clean energy space. Trump wants to end EVs, et cetera. The real fight now is AI. And I don't see that this is, the two countries are separating their tech stacks. That's our whole thesis with China tech. And, I think the issue right now is, do you want to press that bet, right? So you reduce the U.S. And you go further into Asia, which has been down 5 weeks in a row, is cheap and underowned. Those are the things you want to play.
As you say, he wants to end EVs. Tesla is absolutely soaring today.
Well, that's the Musk thing.
Who do you think is the biggest loser in terms of your tripolar world with this composition we see in Washington?
The U.S., clearly. Because Europe has got to respond. They know that. The whole Draghi report on competitiveness was we got to do more of the things that China and the U.S. are doing. And to us, there's a new industrial policy mix that is being implemented around the world. To compete in AI, to compete with climate mitigation, to compete in conflict, you need public-private partnership because it's too much money for the private sector alone, and the public sector doesn't have the expertise. So who can marry that best is going to be the winner. And I think you also have to think about immigration. Who can leverage the immigration to improve their growth profile is also going to be a winner. And in the policy mix that the Trump team has laid out to date, it's anti pretty much all of that. And so, strategically, as I said, the U.S. dollar is the most overowned, it's expensive, and the policy mix, in our view, is deteriorating.
There's a lot to unpack there. I just want to pick out a few things. The former president, now president-elect, has been quite clear that he wants national champions, which is why there's the proposal on the campaign to drop the corporate tax rate to 15% with conditions for domestic manufacturing. Now, you said when asked who's the biggest loser, you said the US and then you said clearly. It's a clearly piece of it that I'm going to push back on because it's not so clear to a lot of people watching the programme right now. You acknowledge that at the moment, I think you called it a hothouse theory right now in America. That's what it feels like. It feels like if you're investing in America, you'll do well. If you're trying to export to America, you might have a problem. That hothouse theory, what's the biggest hole in the window right now?
Well, I mean, I think it's J.P. Morgan who laid out the case that if Trump implements the 60% tariff on all China imports, that will lead to almost a halving of the earnings growth that's expected for 2025. In other words, the earnings are expected to grow by about $35 next year from this year, 25 to 24. The tariff effect will carve out $15. This is J.P. Morgan's estimates. They got, reams of economists thinking about this stuff. And so you're basically talking about taking your earnings growth and halving it at a time when, you're not going to get multiple expansion. So it's all about the earnings growth. Year 3 in a bull market tends to be the year of rest. We are going into year 3. That's historically the case, typically single-digit returns. And so I think that the idea of national champions, sure, that's why Tesla's probably rocking. Musk is going to be one of the national champions. But I think overall, the whole thrust of the U.S. policy mix has been reshoring, right?
Got it.
And reshoring with the dollar getting more expensive, those two things don't compute. So that's a big hole in my view.
I'm going to suggest those J.P. Morgan economists aren't too unhappy this morning. The stock is up by 6.5% in the pre-market. Jay, it's good to see you.
Likewise.
And seriously, appreciated your time overnight and this morning.
Yeah,
Thank
it's been great. I mean, one of the things that's great about this is that you have to think in real time, right? So by coming on and engaging in this debate and dialogue, it makes our process better. And so we appreciate it. And good luck to everybody, and hopefully the next time we see each other, we'll all have had a little bit more rest.
We'll see you soon.
Yeah,
Jay,
exactly.
Thank you, sir. Jay Pawlowski there of TPW Advisory. With an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. The Arizona Abortion Access Act has passed. The state will now amend its constitution to establish a right to abortion and prohibit interference before fetal viability. Arizona is one of 10 states where abortion rights were on the ballot this election cycle. Shares of the U.S. biggest banks, as you mentioned, John, are surging pre-market. Investors are hoping President-elect Donald Trump will make good on his promise to lower taxes and reduce regulation for the industry. The shares also getting a boost from higher yields this morning. During the campaign, Trump vowed to cut the corporate tax rate to as low as 15% from 21% and to eliminate 10 regulations for every new one. NVIDIA became the largest company on the world on Tuesday, surpassing Apple and underscoring just how dominant AI has become on Wall Street. Shares rose 2.9% during yesterday's trading session, resulting in a market cap of $3.43 trillion. That cap tops Apple's $3.38. The chipmaker accounts for 7% of the weight in the S&P 500, and it's responsible for a quarter of the benchmark's 21% gain this year. That's your Bloomberg Brief. John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the programme, the morning calls plus this. Tesla up by close to 13% in the pre-market. We'll catch up with Bloomberg's Ed Ludlow in just a moment. From New York, this is Bloomberg. So is there some tension here? Check it out. Equities up by 2%. In the bond market, we're down. Yields are higher by 16 basis points. For how much longer? Max Kentner, HSBC. If Treasury yields were to rise into what we call the danger zone, a point at which higher, longer-end expectations can trigger a broad-based sell-off, such gains may prove short-lived. That danger zone, 450.
Stuart Kaiser of Citigroup echoing that, although he didn't put a number to it. There are two risks to the equity rally. One of them is deterioration in the U.S. labor market, but the first is that further surge in that term bond premium. So here's the question. When do you hit that peak? Is it 450? Is it more? Does it depend on some of the policies coming with it?
We're getting closer to that. Let's put it this way. Let's get you some morning calls as well. First up, Bank of America downgrading universal health to neutral, viewing Trump's victory as a negative for healthcare facilities. That stock is down by close to 8%. Your second call from Bank of America downgrading Five Below to underperform with a $75 price target. The analyst citing exposure to China and possible Trump tariffs. We're down by more than 13% on that name. And finally, Barclays lowering its price target on Yum Brands to 155. as its brands increase focus on value. Turning to Tesla, the stock surging in the pre-market as Donald Trump secures a return to the White House. In a speech to supporters, the president-elect praising the carmaker's CEO, Elon Musk.
Let me tell you, we have a new star. A star is born, Elon. Now he is. Now he's an amazing guy. We were sitting together tonight. You know, he spent 2 weeks in Philadelphia and different parts of Pennsylvania campaigning.
Joining us now for the latest on the West Coast, Bloomberg's Ed Ludlow. Ed, we missed you overnight, buddy. I want your thoughts on the election and what this all means for not just Elon Musk, but for the companies he runs and owns.
Well, I was awake and I've spent a lot of the night on the phone, as you'd imagine. And, you know, it's not just the alignment between Elon Musk and Donald Trump. It's essentially an endorsement of Elon, right, by Trump on stage, the president-elect. But the potential policy platform that Trump brings, you discussed with your last guest, the winners and losers of this outcome. You know, Tesla's strategy as a global company kind of fits the idea that Trump would want to have conditionality around manufacturing in this country. Tesla, for quite a long time, has had this policy where it wants to manufacture in the markets that it sells into. In other words, don't build cars in America and sell them into Europe. Don't build cars in Europe and sell them into America. But I guess one thing we should talk about is what is Elon Musk going to do himself? The assumption of sources that I've spoken to, and it's an assumption, it's not known, is that any role within a Trump administration or federal government role would be advisory. And what I heard from people overnight is that the plan internally in all these companies is that Elon Musk remains at the helm of them, which I think is a really interesting idea.
Well, yeah, Ed, and that's one of the main question marks. How much can he be the beneficiary if he has to sell out his shares or freeze them and then leave? There are a lot of issues here. There's one with SpaceX and how much that could take over some of the space program in the United States as Boeing and NASA take more of a back seat. And then there's a question about the electric vehicle policy. There is a broad feeling that Donald Trump will be terrible for electric vehicle policy, considering some of his prognostications about it. And yet here you see the shares of the biggest electric vehicle maker surging 14% on the heels of this. How much will the policies of Donald Trump and his next administration help just Tesla or the broader market?
Well, for every winner, there is a loser, right? And yes, Tesla is up significantly, but I'd look to the European automakers, how significantly lower they are in that European session, going back to the same logic that if President-elect Trump were to move forward on the idea of tariffs on imported vehicles, the way that that company is organized, Tesla, it would set up to be a beneficiary in that market environment. You raise so many interesting points. Space is highly regulated, but SpaceX is the contractor of choice for the US government and its activities as it relates to space. And I think one area that Musk has pushed back on consistently is that Tesla or SpaceX in either context are not that dependent on subsidy. I think we could debate that, right? There's definitely evidence in periods of this year where the federal tax credit, $7,500 on EVs, has helped Tesla lease a lot more vehicles. But again, they would push back as a company and say, we haven't taken handouts. We've done a lot of this ourselves organically. The forecasters, be it Bloomberg NEF, Bloomberg Intelligence, the sell side, whatever, they all do feel that under a Trump presidency and Trump term, there will be some repeal of the Inflation Reduction Act and other EV-related policy. Very hard to call.
Ed, on the campaign trail, the former president said, Elon Musk is one of our geniuses, and we need to protect our geniuses. If he had one ask from the U.S. government, he runs 6 companies, what would it be?
Yeah, proceeding on the basis and the assumption that a role in the Department of Government Efficiency is advisory and that this is not becoming some sort of formal U.S. institution. I think that, you know, looking at clues, Musk would seek for things to move faster. The belief where I am, Silicon Valley, is that the reason President-elect Trump was the right candidate for technology was that he would deregulate, cut red tape. And if you think about the direction Tesla's headed, robo-taxis, autonomous driving, the biggest barrier right now is rules and getting vehicles on public roads. And as we discussed, Anne-Marie, a few weeks ago, and I've written about, Musk talked about that quite explicitly on Tesla's last earnings call. And that might be one ask. Make some rules or cut some rules for the future of autonomous driving.
Do you speak to these automakers all the time? Do they face federal hurdles or state-level hurdles?
Both, but remember, the risk can be a tailwind. It works both ways. That take California, for example, or other state-by-state specific manufacturing policy, that's helped some automakers. Rivian, for example, is highly supported by the state of Illinois. But again, it is difficult. I think one complaint that I hear from CEOs, and honestly, if the CEOs of the automakers are watching and you know who you are, speak about it publicly, is they've been very frustrated with the organs of federal government and how little public officials understand about supply chain. So for all of the legislation, be it the CHIPS Act or the Inflation Reduction Act, actually getting money out of the legislation and into the system has been very hard for them, as has been sort of navigating the ability to access raw materials. China is something we haven't really talked about, but we could talk about a bit more, given how critical it is for supply chain and end market as well. The point is those CEOs are frustrated and have been for the last 4 years or so.
We've got months. We've got 4 years to talk about China. Sure. Ed, I just want to squeeze this in, just quickly. Where is he going to find time for this? Where will Elon Musk find time to do all this?
Very fair, reasonable question. Simply, he spends a lot of time on his cell phone and on his jet, which is Starlink Wi-Fi enabled. He doesn't sleep very much, by all accounts, and you can see that from his social media presence. I think that he's just one of those people.
Just incredible. Ed, thank you, sir. Appreciate the update from the West Coast and looking forward to your coverage alongside Caroline Hyde at 11 o'clock Eastern Time on Bloomberg Technology when they go through some of these issues. What a phenomenal character. We're talking about some of the biggest companies on the planet. If you could own one and run one, that would be a win. But we're talking about multiple platforms now.
SpaceX, Tesla, X, the AI company he's starting, and now he's potentially going to have this advisory role. So here's the question. At what point will the policies just benefit him versus the broader industry? Because what you're seeing right now is auto manufacturers in the U.S. actually getting a little bit of lift, not like his. But it doesn't seem to mean, at least in the market's eyes, that this is going to be wholesale terrible for car makers that make EVs in the U.S.
I just want to know where this $2 trillion he says he can cut from the U.S. government is coming from. Because even if you fired everyone in the U.S. government, you're not saving $2 trillion.
Up next on the programme, Torsten Slok of Apollo. A man who thought the Fed would pause in December. I imagine he feels pretty good about that this morning. We'll speak to Gennady Goldberg as well of TD Securities. So here's the first upgrade. Chris Harvey, Wells Fargo, raising the price target on the S&P 500 to 58.30, which is close to where we are, from 55.35. They say sell the news is over, buy the election, the pain trade is a rotation. Let's talk about what's happening on the small caps. Absolutely flying going into the opening bout. The Russell right now up by more than 6%. With some movers this morning. Manus Cranny, take your pick. There's so many. Good morning to you.
Jonathan, it really is take your pick for the Trump anonymous trade. You spent a little bit of time on Tesla. And I think what you've got to do here is to say to yourself, this is the very personification of FOMO. But you need to disaggregate between the emotional part of this trade, in other words, the affiliation between Trump and Musk on the campaign trail together. A new star is born. And the financial. And I think Dan Ives tries to do that this morning. He says that this is a $40 to $50 boost for Tesla from pricing and scale. If you've got the president's ear, how much of the EV-related provisions are actually going to be rolled back? And that's about access to conversation, which creates policy. Roll it over. Go to the banks. Why not? It's probably what we do best at Bloomberg. Bank of America, it's a mere representation of JP Morgan, Wells Fargo. This is about capital, status quo, and deregulation. We don't really know what kind of deregulation you're maybe going to get, but capital, status quo, that is very, very different. And what Bloomberg says is you can stave off the 9% capital increase. You get a watered-down version of that. That's the bid side. The offer side is, of course, higher yields. What does that do to your mortgage? What does that do to your consumer customer out there in the United States of America? It certainly boosts your NIMs. And I leave you with a soupçon of Coinbase. Bitcoin smacks out that record high, but I like what the CFO had to say. Not what I like, but what he said. Foster crypto innovation over litigation. Mike Novogratz goes for $100,000 on Bitcoin by January. And Bloomberg's brilliant line to close it off, Jonathan. Crypto's political muscles, they're strong.
Manus Cranny, appreciate it, sir. Thank you. Let's turn to bonds as well. That's an equity picture Bonds are sliding. I think that understates the move. Yields are higher by 17 basis points. The 10-year, 4.4452. The Trump trade gripping markets this morning worldwide. Tomorrow, attention turning to the Fed rate decision. Torsten Slok of Apollo expecting a 25 basis point rate cut, adding, quote, "We don't expect the Fed will cut interest rates in December." Torsten joins us for more. Torsten, good morning.
Morning.
I'm not sure if you've been to bed, so let's start with the election. Good night, good evening, wherever you want to go. I want to understand whether this has changed anything for you or just cemented what you were already thinking.
Well, I think, of course, what always comes with elections is that now we need to figure out what policies are actually going to be implemented. It's clear that yesterday at around just before 9 p.m., we found out what the Trump trade really was, namely that rates were going higher, the dollar was going up, and stocks were going up. So from that, of course, we can derive that, well, if this continues, it does, on the one hand, mean easier financial conditions because of the stock market going up, but it also means tighter financial conditions because long rates are going up. So now the challenge for markets is to figure out, why are long rates going up? Are they going up because of the economy expected to be better? Or are long rates going up because of worries about fiscal sustainability? And this becomes a very important debate, namely what will the term premium, meaning what will happen to the part of rates that in long rates that have nothing to do with Fed expectations. So therefore, the conclusion is that we still need to wait and see what policies actually will come.
Which one do you think it is and why? Where's the tell?
If I look at my Bloomberg screen and the term premium coming both from the San Francisco Fed and the New York Fed, they both say that the term premium in the last 6-7 weeks has been going up more than 50 basis points. So that's telling you that rates in the long end are going up for reasons that have nothing to do with Fed expectations. So now it becomes, therefore, a little question about, okay, so if rates are going up for reasons that have nothing to do with Fed expectations, what could those other reasons then be? And traditionally, one interpretation has been that markets do focus on fiscal sustainability. And given that both candidates have been scored by the Penn-Wharton budget model and the Committee for a Federal Responsible Budget, that we will have more deficits both under Harris and under Trump. One interpretation has been that rates have generally been going up in the last month or a little bit more because of renewed worries about the fiscal situation.
That said, this morning what we're seeing is small caps ripping. What we're seeing is some of the consumer cyclical stocks ripping, some of the lower rated credits actually doing very well, which actually flies against this idea that it's going to be tighter financial conditions that constrains the economy. Instead, it suggests something about growth reaccelerating. Are you saying that this is an inconsistent response from the market, or can you take that as sort of a signal here?
Well, for small cap in particular, absolutely rates higher for longer is negative, because let's remember that 40% of the Russell 2000 have no earnings or negative earnings. So that means the Russell 2000 companies are characterized by having low coverage ratios, meaning very little earnings to pay for their interest payments. So that's, of course, negative for small caps. What's positive for small caps is likely, first of all, we may get now get more growth, but also from a regulatory perspective, if we now have that the Republicans are going to, at least as the market textbook would say, create an environment that is, in the market's language, more business friendly, well, that would also be a reason then why small caps should now be benefiting. So there's a tug of war going on between tighter financial conditions, meaning higher interest expenses, and at the same time, what could be characterized more tailwinds to the business environment.
I'm trying to get my head around this because I want to understand how the Fed's going to grapple with this tomorrow and how Fed Chair Jay Powell is going to signal about yields going higher on the long end that ostensibly should be tightening financial conditions, but aren't, if you see ISM services like what we saw yesterday, but aren't if you see what we're seeing in the employment market. At what point does it become a concern? What are the red flags to you?
Exactly. So that's why tomorrow is easy for the Fed. December is really difficult, because now we get to the very difficult situation that we already, even before the election, had ISM services going up really significantly, including the employment component. We've all been assuming now for several quarters, employment is slowing down, non-farm payrolls will gradually weaken. But then suddenly we began to see, of course, in September, non-farm payrolls went up. October was distorted by the weather. But if we get a payback from the weather in here, the data for November, and on top of that, we're already seeing ISM services for employment also going up. The challenge for the Fed is that both organically, if you will, the economy is actually still in a good spot. And now you have some questions about, well, what type of policy will come? Will we have more fiscal policy? Will we have, therefore, more support to the economy? That will then become the challenge for them in terms of what they should be doing in December.
Well, Torsten, the highly regarded Cook Political Report just put out a note saying the most likely outcome now is a GOP trifecta. Former Speaker of the House, Kevin McCarthy, just texted me saying the Republicans will keep the House. This is someone that knows the House very well and also knows those California districts very well. So if there is this trifecta, what policy can actually get done?
Well, so now we go all back and look at the Penn-Wharton budget model, which had a quantification of what would be the implications for GDP of the potential here of a red sweep? And the answer to that is that we will generally see a boost to the economy. We will probably also see some boost to inflation, which will certainly complicate the Fed's job. So that's why it remains to be seen what of the things that Trump has talked about he will be implementing. But if we do get a red sweep, then certainly we should be going back and studying hard what has the quantified models been showing in terms of the implications for the economy.
How does Jay Powell talk about this tomorrow?
Well, it's a very difficult challenge for him here because obviously if we agree that tomorrow is easy with 25 basis points cut, then how do you start to talk about including this in your forecast? I think that one way that he might begin to talk about it is to say, well, we just don't know what exactly will happen. We don't know which of these policies will be implemented. So we have a list of things that Trump has talked about, and they have all been quantified by a number of different institutions. But what of these things will actually come through and in what order of magnitude becomes a very important issue, of course, for the Fed.
We can play around with this a little bit. Does anyone start auditioning to take Chairman Powell's job?
Well, as we all know, his term will run out in May of 2026. So now we will already begin to have, in the second half of next year, a debate about who should be the next Fed chair. And of course, this will also become a very important part of discussion in markets.
We're going to have it right now, aren't we? Doesn't that debate start right now?
100%, especially because what we were talking about with Thomas Honig, I think we cannot emphasize enough. The tools that the Fed has are not just cutting rates. They also are quantitative easing. They also are bond purchases at a time where there's a real question about the long end. And I wonder how long before we start talking about that.
Torsten, just one final question. How similar is this to 2016 when we were waiting for the tax cuts to come from the Trump administration? And we're having similar conversations with Fed officials. I remember the news conferences. I remember the Fed speakers at the time. It was, at what point do you start to bake this into your projections? And they had to wait until it became reality. Is it much worse than that? Is it the same? Do you see some parallels here?
This is very different because at the time we had two policies. We had lower taxes, the TCJA, Trump tax cuts, and then we had at the same time tariffs. Now, we don't have significant tax cuts, at least not of the same magnitude. So if the tariffs are now going to be even bigger than what we had in 2017, then you can begin to wonder, well, if we don't have the offsetting effect that tariffs will, generally speaking, lead to higher prices and, generally speaking, the risk of lower sales, there was an offsetting positive effect to the lower sales part by the tax cuts, and we don't have that magnitude of tax cut potentially. There are some suggestions that he's talked about lowering corporate tax rates to 15% for domestic manufacturers, so that could maybe offset some of it. But given what we're talking about on the tariff side is so much bigger than what we had with 60% on China, than what we had in 2016, that means that the risks are more tilted towards tariffs potentially playing a bigger role.
This is the beginning of a much longer conversation, but just a final word. 2025 rate hikes? You ready to go there?
Well, if we now get a tailwind to growth from a better business environment, from easier fiscal policy, and we might also have a little bit higher inflation because of tariffs. If we deport illegal immigrants, that might also be lifting wage inflation. That would all be arguing for the Fed definitely not cutting as much as the dot plot is telling us at the moment.
Torsten Slok of Apollo, one of the very best. And the market and policy is moving in his direction, that's for sure. Torsten, thank you, sir. If you are just joining us, welcome to the programme. In about 50 minutes from now, this market will open up and small caps will rocket. Equity futures right now on a Russell up by more than 6%, on the S&P 500 up by more than 2%, on the Nasdaq 100 up by 1.8%, and in the bond market, we've got to look at that too. Check this out. Yields higher by 18 basis points on a 10-year, on a 30-year up by 20, 464 on 30s, Lisa approaching 450 on 10s.
Just ahead of a $25 billion auction of 30-year notes at 1 p.m. today. A real question, as Priya Misra of JP Morgan says, these are clearing events. They are risk clearing events where we can find out the new price. Does this stick? Do the buyers come in? If they don't, does that change the tenor of how people look at this as almost a benign sell-off in bond prices with yields going higher simply because there is the expectation of something of a growth shock?
On the bond market, jumping into the seat, Gennady Goldberg of TD Securities. Gennady, it's good to see you.
Thanks for having me.
Bonds are on sale. Are you buying?
I'm waiting until they stabilize a little bit. I think at these kinds of events, you said market clearing event, and it's certainly going to be one of them. We have to wait until this plays out. We have to wait until the market settles down into a new equilibrium. Then we could think about jumping in. I think at this point, rates could continue to edge higher until we know the extent of Trump's policies. And that might take a little time as well because we still don't know exactly who won the House.
Given that, how unfortunate is the timing that they're selling bonds of 30-year denomination later today?
I'll put it to you this way. I think the Treasury will probably not make this mistake again. That being said, they've done it in the past. Yeah, I'm sure they'll take a note. But I think they'll be still somewhat bought. I mean, I'm not expecting a massive tail at this auction, but if there is weakness here, it could suggest that maybe we shouldn't be scheduling auctions for election days. It is tricky, though, right? It's hard to concentrate this series. It is the big one, theoretically. So it's, every 4 years you're forced to do it.
There's a real question, especially as the dust settles, about what of these knee-jerk reactions will actually stick. And the point that John was making earlier about the divergence between the European bond markets and the U.S. one is just really surprising. You see bond yields actually declining across Europe. You see bond yields surging in the U.S. At what point do you buy into that? Do you expect that to widen? And at what point is this, again, a moment where something else is going on? You don't want to get involved.
I think you always want to wait a couple of days for things to shake out, especially big election events like this. Markets have trouble pricing election risks, period, right? Historically, they will adjust until kind of the right level. I think the issue here is twofold. One, we still don't know who won the House, so we don't know the extent of potential tax cuts, potential fiscal policy. Two, we still don't know what the impact is going to be on tariffs, on immigration. These are all things that Trump has said in the campaign. The question for investors now is, how seriously is he going to take them? Tariffs are easy. Tariffs are really up to the president. The immigration part has to take a lot of work, a lot more work. I think that might involve Congress to some extent. So if he doesn't actually win Congress, it could make it a little bit more difficult. And that is one of the swords that's kind of dangling over the market in this uncertainty. So we still have to wait for these things to shake out before we can actually see the real damage.
But we know what he wants to do on tariffs. And Trump 1.0 moved in quickly on tariffs. Maybe not as big as he's talking about now. Isn't it enough to make moves on?
I think the tariff side is likely, right? So if you're looking at the extent of Trump's policies, tariffs are quite likely. The big question for us is immigration, because that could actually be quite a bit more damaging for the next several years, not just for next year. We're talking about a 10% tariff across the board. We're still not entirely sure whether it includes the USMCA as well. That might just be a threat and might not materialize. But if we're talking about, mass deportations, as Trump has talked about, that could be huge for the labor market, which has actually now come into much, much better balance. And actually could be inflationary for wages. So it could put some long-term price pressures on the U.S. economy.
Nobody knows what's going to happen. What we're doing around this table is just pure scenario analysis. Does the Federal Reserve need to do the same thing publicly?
I think it's a little too soon for them publicly. Tomorrow is going to be an exercise in saying nothing for about 45 minutes at a press conference.
And reading the notes.
And really reading the notes and trying to repeat themselves. And to be fair, they also don't know, right? They have to wait for this to shake out. I think a November cut is effectively a done deal. December still very much up in the air. Really depends on the data. Once you start getting into next year, once you get past the inauguration, and to the earlier point, Trump 2.0 is going to act a lot faster than Trump 1.0. We have to see what's coming. There is a risk, certainly, and I think the risk coincides with some of the stronger data we've been seeing. They may want to take their foot off the brakes a little bit.
They've got a bias to ease. Have we just disrupted that?
I think we've softened it, is the way I would put it. I think the Fed is still moving in the direction of easing. Now we've thrown a major wrench into that major source of uncertainty. They'll have to see how it plays out. All else equal, I think they still keep taking rates lower. But even with the data the way it's been, it's still not as fast as it would have been before.
I'll finish with the same question that I asked to Torsten Slok at the end of the interview, and hopefully you were listening. Rate hikes 2025. Are you ready to go there?
I don't think so. I think a much more likely scenario is Fed on hold for a lot longer than anybody anticipates. So let's say the first 6 months, the first 8 months of next year, maybe even all of next year, if the economy is still doing well and we're getting inflationary pressures. I still think rate hikes are a long ways off. That would be quite different from what they're doing. Not impossible. I think the market will start to price in some chance of that, but I still think cuts over hikes.
Let's see how quickly this conversation changes as we make our way into 2025. Gennady, it's good to see you. Thank you, sir. Gennady Goldberg there of TD Securities on the bond market, on fixed income, and on the Federal Reserve. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Hurricane Rafael is gathering strength in the Atlantic Ocean. According to the U.S. National Hurricane Center, the storm has sustained winds of 90 miles an hour. That makes it a Category 1 hurricane. It's expected to make landfall in Cuba later today. The Florida Keys could also see localized flooding, according to the National Weather Service. Bitcoin hit a record high as markets watched votes come in for Donald Trump overnight. The largest cryptocurrency topped 75,000. It's widely viewed as a Trump trade because he embraced digital assets during his campaign. Crypto-related stocks, those are also rising in the pre-market trade. Democrats are holding out hope that they can avoid a complete red sweep and take control of the U.S. House. Democrats need a net gain of just 4 seats to wrestle the slim majority from Republicans. But with several key races still too close to call, particularly in notoriously slow counting California, it could be days before it's clear which party has the majority. And that's your brief. John.
Hey, Danny, thank you for this morning and overnight as well. We appreciate it, Danny. Thank you. Up next on the programme, we'll set you up for the day ahead. From New York City, you're watching Bloomberg Surveillance. 40 minutes away from the opening bell. I'm exhausted already. We've got a full day of this ahead of us and a Federal Reserve decision tomorrow. Equity futures on the S&P up by 2%. Bond yields higher by 16 basis points. A 10-year 443.54. As we count you down to the opening bell, here's the trading diary. The next couple of days looks like this. Tomorrow, a Fed rate decision plus another round of jobless claims plus a Bank of England rate decision too on Friday. UMich consumer sentiment on Tuesday, earnings from Home Depot Wednesday, US CPI data next Thursday, PPI plus earnings from Disney. Dropping by the studio, Bloomberg's Michael McKee, our economic and policy correspondent. Mike, good morning to you. Can you give me an impression of Chairman Powell tomorrow in the news conference with you? What is this going to look like? What's it going to sound like for 60 minutes?
Well, they only go about 45 now, which is a benefit to him because he's
maybe
going to be
this one goes 30.
We don't know. They don't know. I think they do the 25 that they've basically told us for this month, and they were never going to really commit to another 25 in December because they're looking at a lot of mixed data lately, and they could say, we'll wait and see what the data say. Now they're going to have to wait and see what policy is going to be. I mean, there are definitely some Trump proposals that would throw, to use a British expression, a spanner in the works for the U.S. economy, and they don't know what that's going to mean to them. So it's going to be a lot of bobbing and weaving and ducking and dodging.
So I can do an impression for you. I was thinking about this morning. Basically, we look at the data we have, we respond to it. There is a moderation in the labor force. We have seen that inflation has moderated and seems on a downward trajectory to our 2% goal. So we are on a path to cut rates incrementally, but we will evaluate data as it comes in. Key question I'm curious about. How do you interpret the long end of the yield curve rising so significantly? How concerned are you about what that signals if it does tighten financial conditions at a time where you think that this economy is fragile, and if it doesn't, about where the neutral rate is?
Well, that's going to be an interesting question for the Fed to look forward to. And I think in December, you're going to want to read the minutes because they'll have a much more deep discussion on that. And then in 5 years, we'll get to see what the Teal book said. But they'll lay out all of their thoughts. And as they go forward into January and March meetings, they'll be talking about this more and more and trying to divine what it means. But with the long end going up, if you look at break-evens, that's what's driving it. It is inflation concerns, and that's one of the key things for the Fed is inflation expectations. So we get Michigan sentiment on Friday, but
I think we got the Michigan.
It's not going to tell us much about inflation because of the limited amount of time in that survey. But that's something to watch in the future.
Marie, that was good.
Mike,
I like that.
Well, we did. I mean, we're waiting on the House, but I'm hearing many people think potentially it's going to be a trifecta, reading the tea leaves. Trump told Bloomberg News that Powell could serve out to the end of his term of May 2026, quote, especially if they thought he was doing the right thing. The right thing from the former president, real estate mogul, is low interest rates. His policies may dictate something else.
Yeah.
How does Powell deal with this?
Well, he ignores it as much as possible because that's the only thing he can do. He can't respond to the president, or he just risks creating a market reaction that's going to be a lot of problems for him. He will get the questions tomorrow, no doubt about it, and he'll say, our job is to focus on the economy, and I'm not going to comment on anything else. But it is a question because I don't want to say you can't believe anything Trump says, but you can't believe anything Trump says. So if he says he can serve out his term, he may change his mind and decide, I want to try to fire the guy. Who knows what would happen then? We all end up in court, but who knows?
I've refined that point. I don't think you can believe anything anyone says on the campaign trail. And that's the problem that you've got if you're a policymaker trying to set policy on campaign promises.
Yeah, although there is a market response and there is some sort of read-through that you have in a knee-jerk way. And on one hand, you can say, we look at the economy, but on the other hand, there's like a dumpster fire behind someone and they're like, there's nothing to see here. The data is going to come out. At what point do they feel forced to actually have some sort of comment?
This was a fast and furious Trump sweep. This was 2016. You have to think Jay Powell last night and this morning was thinking, I wish it was 2020. I wish I can go into this meeting and say, we can't comment because we don't know. They do know. And they do have an idea of how Trump 2.0 will be because they can look at Trump 1.0.
Michael McKee, it's good to see you, sir. We've got to leave it there. We appreciate it. Thanks for catching up.
The dot plot's out the window, put it that way.
Yeah, we'll get a new one of those in December. I'm not sure how useful that's going to be. We'll have special coverage of the Fed decision and Chairman Powell news conference starting at 1:30 tomorrow on Bloomberg TV. We're going long once again. Tomorrow morning, we'll catch up with Laurie Cavacina of RBC, Stuart Kaiser of Citi, Binky Chadha of Deutsche Bank, and Dana Peterson of the Conference Board. The comeback kid, 78 years old, from Queens, New York City, the 45th President of the United States, poised to become number 47. President-elect Donald Trump. From New York City this morning, good morning. This was Bloomberg Surveillance.